Hello, ladies and gentlemen. My name is Vozane, and I'm excited to be with you here today again in this session of 1.4. It's an extremely an exciting session because that is where now you get to understand. In other words, we're getting now to the gist of what we're trying to do. And in 1.4, we are dealing with two things: the SPPSA value chain and the combined assurance annexure. Now, perhaps let us start from the beginning to find out what has happened so far. So we've already done cycle 1.2. And we've done cycle 1.3, and in cycle 1.3 we're covering volume 0, which contained chapter 1 to chapter 20 of the volumes that we want to do. And so there is a book that details that, and there are slides. So you'll realize that when I'm dealing with the slides are mine and the book is for you. So there is no issue about me summarizing the slides. You've got the book to make sure that everything is okay. So in 1.4, we will be dealing with these ones, the SPPSA value chain and the combined assurance annexure. I'm very excited about the combined assurance annexure because that's the one of our key products that we're introducing to the market, to say, in the event you want to compare, in fact, from where we are set is that we believe that so far there is no tool that is used to compare small businesses, and with this combined assurance annexure, it helps us to have bases in which small businesses can be compared, and we're gonna go through that. Perhaps let us start with the SPPSA value chain. So, what we want to do at SPPSA, we want to be the voice of education for small businesses. That's what we want to do. Then we take this voice and we put it at SPPSA, and we allow ourselves to be accessed by the small businesses. Then from there, we professionalize the environment, as you would have seen in our frequently asked questions. And the professionalization starts by us admitting members, prescribing the CPD, and of course, creating working channels to say who's gonna do this, who's gonna do that, and we call that the separation of work. And from there, we extend our professionalization to educational institutions, because we believe that with educational institutions, that's where our role will be magnified. How is that? Because if we want to move to a certain direction, which is educational in nature, we should have some form of support from educational institutions so that they are able to teach exactly what is taught in fact, what is taught, what is needed to be taught, what small business needs to be taught, so that by the time the graduates come to small business, they know exactly what is required. So far, we don't have a curriculum that addresses specifically what we want to address, and we are appealing to educational institutions to buy into our mandate. And from there, candidates are going to write board exams and qualifying exams, and they get the designation. Then from there, we provide CPD and accredit some institutions. What we're trying to do now is to check if it's not viable for the lecturers, at least, even if they are not getting into the profession with the speed that we want, at least they register for CPD. At least they keep update. They are updated of what is required. So far, we have identified two things. That is the two challenging dimensions. So we've targeted the South African Revenue Service. We want to deal with that we want to take that out of the way. And number two, we want to teach people on how to deal with the Department of Labor, because most institutions now have employed one or two people, and once you have employed people, we then have to understand what then needs to follow. Two things that needs to happen is we need to teach people how to control the revenue, how to determine revenue, and secondly, we need to teach people on how to determine the cost. Then from here, we go to the 4 pillars of awareness, which I have already briefly discussed. One is the education, and two is the small business environment. On the cash part, as I've already mentioned, that we want to deal with cash. On the cash part, we want to teach people on how to deal precisely with sales. We want to teach people to deal precisely with credit and cash sales. All right, and what is the overriding what is the overriding what is the overriding documentation around that? Okay, so you have to decide what type of revenue structure you want to employ, and the revenue structure, we mean credit or revenue, I mean credit or cash, and of course you will determine the percentages to say how much is credit and how much is cash, and then we assist you on how to record and document that. Of course, on cost, we want to introduce a number of costs on, in fact, how to determine your cost. So the determination of cost, what we're trying to teach people and what we're trying to teach the guys who are getting into the profession, especially those who have got a Bachelor of Accounting, but not a CA stream, normal general accounting from a university, and anyone else who's coming from finance wants to join our stream, and guys who've got business management qualifications. So with TVET colleges, we're targeting N6 business management and financial N6 financial management. So with those ones, they are strictly our people. So we teach people on how to determine cost, especially the students. So when the student comes from a blank environment, in other words, from a tertiary institution to SPPSA controlled environment, we teach them on what is on-premise cost. We teach how to identify costs using an on-premise method. Then we teach them about the importance of emails. We go through the bank statements. We use the SMS notifications. We use the transactions with transaction logs, and we use the documentation and location of cost within the business, and we then build the database. And once you do that, then you get to the information session with management. And these information sessions are the ones that we have talked about in the previous video, where we were saying, now what we're trying to do, we don't want to make accounting an isolated event. The financial records clerk needs to have a meeting with the small business practitioner, and together they need to have a meeting with a chartered accountant once a month, and we've detailed that in our planning calendar. So that takes care of the supply, the small business, the SPPSA value chain. Let us now go to the gist of the issue. Now here we are introducing a template called a combined assurance reporting template. Some of us are calling the combined reporting annexure, and I've since realized in the building that some are calling a combined annexure, reporting annexure. Others are calling combined assurance annexure. Yeah, something similar to that. But once you say combined, you are talking about this. So it's one of our exciting products that we have introduced uh, to start gearing up the professionalization of small businesses. So this is taken as volume 1 of this template. And there are instructions there on top, even though it's not written like that, but you could see that these are instructions that are written on top. So I think what the instructions say is that when you get the template, I'm sure you will get the template on Excel. Then you need to be careful of the responses here. So they are saying each question has got one response. So it's a yes or no. So there is no partially or what. It's a yes or no. It has happened or it did not happen. So that's what they do. That's what they say. So if it has happened, you put yes. If it has not happened, you delete yes and you put no. If it has happened, you delete no and you leave yes. All right. So that's what they are saying there. And they say no must be shared with a red shade. So we'll need to shade this one. I mean, we'll need to shade red with, with a red, just to magnify it that this is red. I suppose that the author of this document wanted to say, then you need to shade yes with the green part. So I think that's what they were trying to say over there. So I think what is important is that you just have to make sure that you delete what is not applicable, then you remain with what is applicable. And look at B, what they are saying. B, they are saying our standard 80% of yeses signify an achievement. So if anything is less than 7, if anything is less than 80%, it means it has not been achieved. I think it's quite a rigorous and a determined process, and to start something like this, and you start at 80%, because I thought SAP, what SPPSA would do, they will say maybe in the first year 50%, then in the second year 65%, in the seventh year 75%, and so forth. But they don't do that. They say from the beginning, we want 80% achievement. So I think it helps the guys who are getting into the profession to understand these standards, that look, is this something that I really want to do? Do I really want to be involved in small businesses? And it helps the educational system as well, our TVET and our our tertiary institutions to really gear up students for this nice challenge. Of course, I think I should also state that, say, we accept 2-digit percentage on the final completion determination. I think that's what they are saying there, to say here there must be 2 digits. In other words, we need to highlight the most prevalent one. So if CR1 is yes, we need to highlight yes. And if there is a yes, it must be 2 digits. In other words, it must be more than 80%. It cannot be less than 80%. Okay, so if you look on the combined assurance template, immediately you will pick up that it has got chapters. For instance, this one is chapter 1, and if you pick up volume 6, if you pick up volume 6, you will realize that we will deal with volume 6 later on. You will realize that, but volume 6 is also attached in this cycle CPD. So you'll notice that chapter 1 is business idea. Chapter 2 is forms of ownership. Chapter 3 it's tax preamble. Chapter 4 is when you're disposing your business, small business. Chapter 5 are the tax consideration. Chapter 6 is death. Death is very small. Chapter 7 is VAT. I expected more from SPPSA on VAT, but perhaps they've got a way of dealing with it. Then chapter 8 are financing of a business. Chapter 9 are assets. Even on assets, I expected more. But I think what they are trying to do even though they want 80%, but the scope of work they want on each chapter remains achievable. I think I like that about them. Then we move to employees, chapter 10. Wow, look at employees. I think the reason why you find employees getting to 25 of the question is that remember, SPPSA mentioned to us that they want to address the Department of Labor and SARS. So I think that's why you will find employees going up to 25. Then you find revenue. Revenue is number 11. Revenue is one of the complicated chapters in volume 6, and I was hoping that at least if they are going to up to 25 on employees, maybe they will go up to 18 on revenue, but perhaps there is a reason for them to that. Maybe the bulk of the work is in the teaching with regards to revenue. Inventory, it goes to up until 12.8. Then companies, I think with the Companies and Intellectual Property Commission, it goes to 4 questions. I think the reason for that is that people are faced with different challenges when it comes to CIPC. So maybe they understand at SPPSA that they might not be able to cover all the challenges that people face. Then we go to chapter 14, cash and cash equivalent management. It goes to chapter 13. I think this is one of the complicated chapters, cash management, and I was hoping that they will go up maybe up until 20 questions to be solved there, because people, cash is king, and the way in which people deal with cash really needs some form of education. But as we previously mentioned, maybe perhaps the strategy here is to get the 80%, but make the 80% to be achievable. Expenditure I was hoping that we're gonna get a lot more from it, but remember, expenditure is a combination of all the chapters, so perhaps some of the work has been captured from the previous chapters. Management account, then management account is a summary of all the financial affairs of the business, and financial statements is the ultimate document that we're gonna be dealing with. We're gonna be dealing with financial statement in CPT 1.5, then if not CPT 2, I can't recall. Then the environment 1.8, then chapter 18, then it ends there. So you'll realize that I think what SPPSA have done, they looked at volume 6. Volume 6 constitute of 20 chapters, but themselves they are prescribing that we deal with only 17 chapters. Thank you so much. Now let us get to it and understand what is it that they want from us in each of these chapters. So we're gonna go through each question here. All right. So the understanding here is that you will go through the combined reporting annexure, right? As we're gonna go through it now, then you park it, then you go to 1.4, CPT 1.4, then you understand how this annexure fits into the financial statements. Then you prepare yourself to a very detailed and comprehensive lecture of volume 6. Then as we go through volume 6, you will have your financial statements in front of you. You will have the combined reporting annexure in front of you, and you will have the slides as well for volume 6, so that as you go through, you understand what is required. So the first chapter there is business idea. So with the business idea, here is the person starting the business, or purporting to start the business, or showing a desire to start the business. So the business is not yet there, the business itself. So the person is still formulating business in his or her mind. Because remember, with the business idea, the business must work perfectly in your mind. That's what we are saying there. Before you can start to write, before you can want to do that and do that. Okay. So here are the questions that the SPPSA is asking. So here is the response. So delete the inapplicable as we have been told in part A of the instruction. Is there a process of assisting the business to continue for the foreseeable future? Then if you say yes, then you leave yes here. And if you're saying no, you will delete yes and you have no. So what is important here, which I think I should warn you guys, is that you cannot say yes, because remember, at the end of the annex chart, the chartered accountant has to sign it. And our understanding at SPPSA is that the chartered accountant cannot just sign something that they did not see. All right. So if you are saying if you are saying yes to this question, there is a process of assisting the business to continue in the future. We need to see a chartered accountant needs to see a valuable proof of that, to say, with this information that I've received, with this type of documents, with these efforts, I see that this business can continue in the foreseeable future. Yes, I don't think here that's when we're talking about the testing of the going concern, but we're talking about the situation where the owner perhaps might get deceased, or might be deceased, or might decide to leave the business, or is attacked by one of the diseases and cannot continue with the business. So this question is addressing that. What is your plan to make sure that the business continues in the case of unforeseen circumstances? Has the South African compliance South African compliance law expectation observed and continuously updated? So I think here we need to so this question cross-reference to chapter 11 of the program. We've already shown you the program. So chapter 11 is dealing exactly with that, to say, is the owner aware of the laws that are affecting the business? All right. So the answer should be yes, because once you say no, it means that you're gonna be in trouble there. Okay. Current and previous ones, amount owing by them, communicating, tracking, including documents relevant to them. I think the question here is that because you've got suppliers, do you have a schedule of suppliers? Are your suppliers well documented in terms of who they are, how to contact them? How to contact them means their telephone, their emails, who do you want to talk to once you have called them, and when have you started contracting with them? When do they start to be your suppliers? And when is your supplier agreement started? Because remember, one of the biggest difficulty is to get suppliers to supply you. Because remember, especially when you are a new enterprise, you'll really find difficulties in people supplying you, because you don't have a lot of documentation to prove yourself. You didn't exist before. So I think this one is about the documentation of your suppliers, and also because you are owing them, then it also requires a documentation of the customers, because 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 your customers will be owing you. So the same thing, when this person start to be a customer, how do you contact this person? How do you access this person? All right. So it goes on, this question, it's one question. It goes on to say, is there a process of identifying, recording, and keeping suppliers, including documents relevant to themselves, amount already paid? So if you are paying a customer first, I think the question is saying, did you know from the first place? So we're going to deal with this when we're dealing with expenditure. I think it's figure 2 when we're dealing with expenditure. It says, when you're contracting with someone, did you first agree on how much the service is going to be, and what is the service is for, and what is the payment date? So once you are unable to pay at the payment date the full amount, so has it been recorded somewhere in your records that, okay, this is how much we agreed to pay every month, if it was every month, but we could not, and we only paid this amount. All right. So oh no, this is question 1.4. I think during the saving, our Excel did not go right there. So 1.4 starts from here. All right, this is 1.4. It's not continuing from 1.3. All right, that's fine. So it's talking about the reason for paying the amount. So it means that in the bank statement you don't just pay, you need to find the reason to pay, which I like. And it says the conduct details, the payment terms and the dates, and the amount that is still owed. So here is the contract amount. The contract doesn't have to be returned. This is how much you owe the person. This is the payment date, and this is how much you have paid, and this is how much is owing. And when we look on your payment schedule or in your bank, in your cash balance books, I think, which is figure 30, if I'm not mistaken, of the expenditure, we need to find the supplier there and the reason for paying that amount, because that reason for paying the amount is gonna assist us in identifying the accounts. Remember, we mentioned here that when accounts are determined using these bases, so when you pay and giving a reason for their payment, you're gonna help us to understand what the payment was for and to create a line item in the income statement. Okay. Does the business have a community upliftment strategy? In other words, I saw two businesses, including Kunoka. Kunoka, I think, started so far, because here, what is nice here is that you don't have to do $1 million strategy. So a community upliftment can be anything. For instance, I think what Kunoka has done, they are buying Colgate and toothbrushes for the school kids, in one of the school kids, so they can say yes there, because what you need, you just go to a school and say, look, this is what I want to do. I've realized that children have got teething problems, and maybe they don't have Colgate at home, and they don't have perhaps toothbrushes. So we want to buy toothbrushes for the school that we're gonna deliver in a 3 month basis. All right. So can you calculate for me how many kids are here in this school? Then every 3 months we're gonna donate with toothbrushes. So that's a community upliftment. And I've seen another entity, it says how many kids without socks, school socks, then they buy socks. So it's not a difficult thing to do, and you can include it there. Does the business keep a value added statement? A value added statement is a document that I'm going to take you through. I think we need to do that in 1.5. Let me write down 1.5 value add statement. I think I'm going to substitute I'm going to substitute the financial statement in cycle 1.5, and we're going to deal with value add statement. That's where now I'm going to show you what is that. But basically, a value add statement is saying, here is the amount that I've received, and here is the amount that I've spent. So the amount that I received it from these categories, and the amount that I have spent on these categories. So it shows where the value of the business is segregated or segmented. So you can plot a graph to say this is the manner in which the value of the business is distributed there. The business has one or more person in the leadership position of the business. Who else other than you is taking a business forward? In other words, what will happen to you in case you are not there? All right. So what is happening here is that you will also say yes or no. Okay, which could be tricky, because most of the businesses are run by, they are one man show. Okay. I think what this is trying to do, because one of the things that SPPSA said in cycle 1.2 CPD, they said they want to create businesses that will employ the children of the owners, or the children of that generation. So I think with them trying to, in fact, asking this question to say, do you have someone else other than you in a business? they are trying to say, don't make the business to be dependent on you. All right. And once you do that, it helps to improve small business leadership, and it helps improve the sharing of resources, and it also gives relief to know that no, if I'm not there, someone is there, and it also gives another relief to say the business will continue, and it tries to reduce this thing of businesses dependent on one people. Does the business keep an updated list of its related parties? I know some businesses that you'll find that it has got related party transactions. For instance, ourselves, accountants, you find that you're an accountant, and in the accountant, in your business, your wife is your client because you are doing accounting for her or your husband, and your in-laws, your uncle is also running a construction company, and you are also helping that person with their books, and you've got a doctor who's a friend, you are also helping that person. So those are the related party transactions, and SPPSA is saying have a list of related party transactions so that we can know how you are dealing with them, or how many they are in relation to arm's length transactions. Because if your business has got more related party transaction, it has got a chance to fail. All right, as composed to a business that has got more arm's length customers. So SPPSA wants to compare and say this business heavily relies on family, and sometimes you know that when family doesn't pay, you don't have a recourse. So what they want to understand at SPPSA is that without family members, will your business be able to continue? Does the business, I think numbering has to be sorted out here. Does the entity have a budgeting preparation process, including monitoring its budget spending? All right, I think that is 1.10. So what you will see when we're doing budget, when we're doing expenditure, you will find a template they will call it budget, a template of budget versus actual. So in that template, you'll realize that we don't start a year. First, we don't start a year without budgeting, because we want people to understand that finances start with budgeting so that you can have a basis of evaluating yourself. And number two, if there is an item that is coming through, which is a new item that was not there when you were doing budget, first you must include a budget for that item, then so that you can able to deal with actuals. So the template is designed in the fact that in the sense that it has got budget, it has got actuals, and it has got variances. So at month end, what the template should do, it should tell us that this is how much you have budgeted, this is how much you have spent on this line item, and this is a difference. A difference could well be that you have spent more than you have budgeted, or you have spent less than you have budgeted. And we on next to the variance, we're looking for an explanation to say what is causing this variance. The explanation is nice because it helps you to conscientize your business processes, and for you to be live with your business. So a business is not something that you're gonna see later. So we want people who are actively involved, who work and live with their businesses. So the variance, the reasons for this month should help you to do better the following month. And these are the questions that will be dealt with in the meeting with the chartered accountant and the financial records clerk. Are employees adequately and continuously informed of how they affect the budget of the business? There is this thing of being so scared about employees. They are untouchable employees in the business. It's not like that. So what is important? There must be a meeting with employees and help them understand how the business is making money, and help them to understand how do they contribute to that, and help them to understand how much are they taking from that? And other than their salary, what other things they do to reduce the cash flow resources of the business, just to conscientize them so that they understand that they've got a meaningful role to play in moving the business forward, and conscientize them that if circumstances go bad, they are the first one to be blamed. Because remember, when you start a business and you employ someone, well, the only thing that you are saying is, please come and help me in this business. So that's the only thing that you require from the employees. They are there to extend your hands, to extend your minds. So when they are doing the job, they are doing the job they are your extension. So you must conscientize them to say, if things go beyond this, I no longer need your help. It means you are not the right person to be part of my business. Remember, we're doing this together, and I want us to have one mindset. And if this is not happening, it means that we must part ways. So, but even though it's not said in rough as I'm saying it now, but there must be sessions where employees are conscientized about the way they carry themselves inside the institution, the way they drink coffee, the way they use electricity, the way the number of times they go to the toilet, the time they take outside the premises, going for lunch, going for tea, the number, the absenteeism, coming late to work, leaving early for work, and lack of determination, and so forth. And these, there are costs involved on these ones, and they can be quantified. That's what we're trying to do with this question. Because normally, if you look on the finances of many businesses, cost of sales will be high, and next to it are going to be employees. Employee costs are normally very high, and employees are a manageable fixed cost amount, and because they are living organisms, we need to have a meeting with them to tell them how much they have performed in each month. So you are trying to regularly conscientize them about their importance in the business. Does the business has a universal business calendar on how its activities take place and get followed? So you will see with SPPSA that we have tried to prepare a calendar which we're gonna be dealing with in 1.6 CPD. So in 1.6 CPD, we'll be dealing with the calendar. But that calendar is mainly for compliance with SPPSA rules and regulations. But in the business, are people aware why is this date important? Why is the 4th important in this business? I cannot take leave on the 5th. My business, my employer is very busy on the 5th because this is what is happening. This is what is happening. Yes, I'm not involved on the production of the documents themselves, but I assist the people who are producing those documents with this and this and this and this and this. On the 20th, this is what we can do. So I cannot take a leave on the 20th. But my business, my employer is busy with this. So you've got a schedule of activities and how they important to you and as a business, and this must be communicated to the employees. So that's what that is all about there. Then, depending on how many yeses and nos, so there could have been a lot of questions that SPPSA has asked, could have asked in this part. That is number one. But they've chosen 12 questions. I think these questions for them now are the most important ones, and I think they are fairly easy to grasp and deal with, but they just need some form of planning and a few meetings with employees to say, look, we have gotten into SPPSA, and this is what they want, and going forward, this is how I want things to be done. Because this doesn't only end on this template. Once you have clicked yes on this template, you must show proof. Once you have clicked no, it says here that no must be shaded with red and must be included in Part H of the financial statement. In other words, SPPSA wants an explanation on why it is no, and I think the improvement plan to say how are you going to improve this in the short, medium, and long term. Short being perhaps within 3 months, medium in 1 year, within 6 months, and long term over a period of a year. So these are the things now. Can you see now we're starting to conscientize We professionalize also the environment. So people don't just do things and say, no, I will see later, I will put. So you sit down and say, if I want to be in a small business environment, I'm going to sit down and interact with my business and understand my business. So it means that you really have to have some considerable amount of time to deal with your business. So we're happy with what they want us to do in chapter 1, and of course we're going to now calculate the number of yes. So it says here number of yes 7 is 58%. It's not compliant. SPPSA does not want that. Okay, number of yes, number of no's 5 is 42%, and it's non-compliant. Then the chartered accountant is going to sign here, and the small business practitioner is going to sign here. And of course, if it's non-compliant, even if it was compliant, but it has got a no, all right, that no will need to go to part H of the financial statements. Okay, forms of ownership, very nice, is asking 2 questions there. Is the business appropriately registered? Looking at the nature of its operations, its affiliation and standard. So what you need to do now is to say, okay, what form of a business I'm running? I'm running a close corporation, which is chapter 2. Okay, is this close corporation still appropriate looking on what I'm doing? All right, I know that some professionals will affiliate to some professional bodies, like doctors, like accountants, like architects, like engineers. All right. So look at your form of ownership. Say, okay, I'm a PTY Ltd. Okay, I'm a close corporation. Okay, is this close corporation a suitable business for me to affiliate in this professional body? All right. Well, there are a number of ways you can do that. You can even ask them to say, look, guys, I'm running this business. Is it correct for me to run this business? And if they don't know, they might just have rules to say, no, the owner of the business must be an architect. The owner of business must be an engineer. Everybody in the CK must be an engineer, and so on and so forth. But if they don't understand really if that form of business is a suitable one for you to meet their requirements, they just have to call SPPSA, and SPPSA will give an opinion and, of course, at a price. Is the business owner aware of the legal implications of the business? Of course, there is a moment where we're going to teach you on the legalities, that is chapter 11, to say, okay, in a business, these are the laws. But these laws are broad as they are in a business environment. These laws relate only to this type of form of ownership. But if you move from this type of ownership to this type of ownership, these laws are no longer applicable. But you just need to consider these new type of laws now. So other than making sure that you are having an adequate form of ownership, there are laws that follow. Hence, it's sometimes very dangerous to have one business that is doing all the things. A good example is LPC, the Legal Practice Council. If a lawyer registered with LPC, you are told right away there that you must register an incorporation. An incorporation or an incorporated is a personal liability company. And there, when you are registering, you must say, all what I'm going to do in this business relates to law only. I'm not going to sell eggs. I'm not going to sell bricks. I'm not going to sell grass. I'm not going to sell livestock. This is all what I'm going to sell, which is a good example because it fixes the lawyers exactly to what the LPC wants. So if the person wants to get into farming also, or wants to do something else, he must register another form of enterprise, which is different from this one, so that there's no conflict. So this is what this chapter is all about. Look, this one is 100% and there's nothing. So if it's 100% and there is no, it means that there is nothing that goes to part F of the part H of the financial statement. Okay, okay, sorry for that. Now we go to tax preamble. Taxation, remember, we talked a lot about employees in the previous chapter, that is chapter 1, but already when we were dealing with the SBPSA value chain, we identified two challenge dimensions. We said we want to help people to deal with SARS, and we want to help people to be compliant also with the Department of Labor. So look what we are doing now here. Immediately, we're talking about tax preamble. Now, in the tax preamble, all right, can you see how you gradually understand your business and what you gradually doing to make sure that you get you get to the professional level of your business? So let us go to 3.1. The business is currently registered in the correct tax category of the business. Then it means your chartered accountant must help you with that one to say, if you are running this type of business and this is what you are doing, and these are your customers and this is how you are making money, this is the correct category. All right, so it helps you to align your processes, because what we picked up is that you find so many businesses doing well, but you say, why the tax is so much? And when you look at it, no, this person is registered on an incorrect tax category. It should not be taxed like this. But because of how it was registered and because of the knowledge of the person who was registering it, he ended up registering in an incorrect tax category. So it's a yes or no, but either way, there must be evidence to say, I went to SARS and I explained my situation, and I went to this date. Here is my ticket number. Here is my ticket card. The reason for my visit to SARS, I wanted to ask if I'm registered with the tax category, and I've also asked for an opinion from my chartered accountant who is helping me in this business to say that I'm registered in a correct business category. Here is the evidence for that one. Then we are all good to go, because what SBPSA does not want, it doesn't want people losing money unnecessarily and paying SARS on things that they should not be paying. The business is registered for the tax type it should have been. Of course, now tax type, which is good, because now you are introduced to a situation where you need to understand your tax type. So are you a business and you are operating? So there is a way of understanding if the business has been operating. Operating a business is not cash into the bank statement to say, no, look at my bank statement, I was not operating. No, it doesn't work like that. There is a way to test if the business was working or not. Then I think I'm gonna infuse that with 1.6, the financial statements, to say, was the business dormant or not? We're gonna talk about the dormant businesses there. So if you are a business, you have made income and you have incurred expenditure, you must register for what we call an ITR 14. We're gonna deal with those ones. ITR 14 is mainly for juristic person businesses. But if you are operating as a partnership, or you are operating as a sole proprietor, then your tax will be ITR 12. That is one tax type. But if you have employed people, we're gonna talk about that. If you have employed people in your business, so it means that you must register for EMP taxation. All right. Both EMP tax and the provisional tax are formed. Both of these are income taxes, but the SARS register them differently. So if you're employing people, you must register for EMP 201. What is going to be included in EMP 201? It's going to be UIF for the employees. We're going to look if you qualify for SDL. We need to calculate for a COIDA provision, and we need to calculate for pay as you earn. So we don't want a business that is non-compliant to the extent that these categories are not employed for. I mean, they are not applied and registered for. So now, how many tax types have we talked with now? We have talked about income tax, that is ITR 14 or ITR 12. We have talked about, so the ITR 12 registers on the profit. We calculate what is the difference between income and expenditure. I just want to show you this. Remember what we have said here. We said What we want to do, we want to have a way in which we're going to help you to control your revenues. So there are serious calculations that we're going to do to show you that, because one of the mistakes that are done by the guys who call themselves accountants is to take every money that you have earned, or which has been deposited into your bank account as your money, um, and and they don't extremely determine the costs. And remember, you are likely gonna pay SARS if your revenue is more than the cost. You are not gonna pay SARS if revenue is less than the cost. So the costs are here, revenues here. You're not gonna pay SARS in that in that category of tax types. So the difference between income and expenditure is dealt with in ITR 14 or ITR 12, all right? So when we talk about your employees, we're talking about employees tax. So in employees tax, there are different categories which are paid to SARS. Yes, some of the employers might pay UIF and SDL directly to Department of Labor, but SDL and UIF can be paid together with pay as you earn to SARS. All right. Then there is COIDA, which is paid normally. The period is between May and 31st of May. All right. So COIDA is dealt with in that period, but that is the COIDA for the previous year. So you could see the determination and the factors that must be considered when we're dealing with employees there. So that's what we wanted to show you. Okay, in some instances, you might want to deal with VAT. Okay, you might want to register for VAT. That is another tax types. There are a lot of other tax types that you might find, especially when we're gonna go through the system and find out what other tax types SARS is talking about and how you register for them. Some of the tax types you don't have to register for them, but they become automatic. So the question here is the business registered for all the tax types? VAT has been a problem, especially with the medical and legal fraternity and engineers. They will say to you, no, I don't want to register for VAT because this money was a once off. That's not what the law says. The law says if you have met a certain threshold of revenue, from that threshold, you must register for VAT. That's it. So if you're no longer making that threshold, you must deregister. That's how simple the South African taxation is. So you cannot argue with it, all right? It doesn't give you a leeway to decide whether you want to comply or not. It gives you a specification, all right? So we're going to help you to do that. The tax types, and we're going to explain what the tax types are, all right? The business has a process to analyze and continuously monitor and evaluate the adequacy of its tax categories. We've already talked about this one to say, now that I'm registered with this tax category, this one is saying, and now that I'm registered, I must not relax to say, now I'm registered with the correct tax category. I must continuously analyze to say, am I still in that tax category? We're going to deal with that when we're dealing with volume 6. Don't worry about it. The management has assessed the tax category in the previous CR template publication for the adequacy for the adequacy and relevance. Okay, what is the previous? So we work on a 6 months basis. All right. Previous template might be it's either you're doing 2 times, which is 6 months, or you are doing it. The reason you are doing it 6 months is because you have realized that you are very far from achieving it. But it can still be done 3 months on a quarterly basis, that is 4 times. Okay, people who are doing it 4 times are doing very well, and people who are doing it 6 times, they are doing it 2 times, and there are people who are doing it 12 times. So that every month, the person, the owner is looking at the combined assurance annexure on a 12 months basis. But because what SPPSA is saying, we are not worried about the frequency in which you are doing. But if you are about to produce financial statements, if you are about to produce financial statements, they must be accompanied with the most recent combined reporting annexure. In other words, your SIRA combined reporting annexure must talk exactly to the circumstances on which you are producing your financial statements. In other words, if you produce financial statements today and say on 30 June 2024, here are my financial statements. So your car, that is your combined assurance, your combined reporting assurance template, must also be for the 30th of June 2024. So there must be no difference between the two. The management is aware how and why they fall within the current tax. In other words, now the accountant doesn't just determine for you and you follow that blindly. I've seen a number of clients where they said, no, Mr. Fuzane, you are bringing us back to school now. We don't want to learn anymore. My previous bookkeeper just told me this is how much you must pay, and I transferred the money to them without any problems. And we want to stop that, because you will realize that that bookkeeper is not well informed. If the person is well informed enough, they must explain to you. Remember, we said every payment that you are paying must be justified, and taxation on its own is justifiable in the sense that for the payment that you have made, you must understand that I am paying 20,000 rand at year end because I am in this tax category, and these are the reasons why I'm in this tax category. So that when you pay 10,000 next time, you still make the same process of understanding to say why I'm paying 10,000 this year, yet I paid 20,000 last year. And if you are paying 150,000 rand this year, why are you paying like that? It could be that you have moved from that category to another category. And these are the things that we want to teach our people. There is a process, okay. Yeah, there is a process of determining the provisional tax for the business. So we're going to teach you to say, what is the provisional tax? Remember, when we were talking about tax types, we said there is a tax type that is called ITR 14. If you are a juristic person, we're going to tell you what is a juristic person is, and we're going to do that immediately when we're dealing with volume 11, the legal as the restricted law. Tax types, ITR 14 or ITR 12, is linked to provisional tax and is linked to EMP 201. This is one tax, but the ITR tax or the ITR 14 and the ITR 12 and the provisional tax, they normally have one tax number. Okay, they share a similar tax number, but the employees tax has got a different tax number. But it doesn't mean that these are one family of taxes. Which family is that? The income tax family. So 3.6 is saying that the business owner must be conscious on how the provisional tax is calculated and what information is required to calculate that. Where SPPSA is not saying the business owner must know how to calculate it, but it means only what they say is that they must be conscious on the determination of provisional tax, and part of that conscious is to understand the law and is to understand the responsibilities, and the responsibility is to understand the time frames on which that tax has to be calculated. I don't think it's limited to provisional tax. I think for me, it's but because normally provisional tax is very hidden and it takes a lot of money from people, and nobody's gonna explain that to you, all right? Because most accountants first don't understand it, and two, they don't want to worry you about it, all right? And one of the problems with provisional tax, I must say it now, that most people don't file their returns on time with SARS. And later when they file their returns, you realize that the financial statement had a profit. For instance, you'll realize that the entity that should have filed financial statements in 2021 has not filed that, all right? Later on in 2025, they filed the financial statements for 2020 in 2025. Now, SARS looked at that and they penalized you because of the profit that you have made, and they charge you interest. All right. So these are the things that we need to explain to people, that SPPSA is coming with a formula that things must be done and be finalized within 1 year. Yes, we must applaud the South African Revenue Services for having tax arrangement to say, if you can't pay the taxes, let us get into an arrangement on how you're going to pay the taxes. But what has been the problem there is to finalize the arrangement. Because remember, with SARS and most entities rely on the tenders, and for you to be awarded a tender, you must show that you are tax compliant. But the only challenge that we have now with the SARS is that it takes longer to finalize the arrangement, and it means in the process you are unable to produce a tax clearance. And you'll find that because of that, people are really doing wrong things to get the tax clearance. So SPPSA is trying to deal with that, and hopefully SARS is also going to align. They are going to align themselves into how they are going to help small businesses to get this right. Because I think SPPSA starts with the logic that um, small businesses really want to do something right. All right. But government must also ensure that the processes themselves that they employ allow for the residents to do what is right. So that is why we are including this in this chapter number 3, tax preamble, to say let us teach people about how tax is determined, and let us also teach about people about the problems that they are going to encounter. And also SARS on their side and Department of Labor, they must also work hard to make sure that they eliminate or reduce or mitigate some of the instances where it will take longer for them to help the clients to get the tax clearance and so forth. All tax returns appropriate close for the business with supporting documents. All returns must have a supporting document. So there's no report, there's no return that should be closed willy-nilly. All right, that's what we are saying there. All right, we've already mentioned what type of returns are those, and we have already, just at a brief scale, we've already mentioned how one registers a particular, how one gets into a certain tax type, and what information then you are required to have for you to have that particular tax type. The business has been issued with a tax penalty. Okay, it's a question, let alone that there is no. So you say yes or no. Okay, there's a reason for that. They are asking that question because they are trying to see if you have been paying on time, or if you have been closing your returns on time. Has the business been issued with the interest if you have not been paying on time? The company has a formal tax arrangement with SARS. Yes, that's what we've been talking about, to say, even if I know that on the books I have made a profit, which my accountant and my financial records clerks have explained it to me, but I don't have cash. Because remember, one of the problems is that the tax system in South Africa is on an accrual basis, and accrual doesn't mean you have cash. So then you will want to get into an arrangement. So for the person who is reading your car, can simply find out that, oh, this is a responsible person, even though things are not going well cash flow wise, but the person is is taking adequate steps in making sure that the business goes forward. And one of those steps is the respect for law. And how do we say that the person has got an arrangement with SARS to pay the outstanding debt? I know how difficult it is to get into that arrangement with SARS imposing very short timelines. But I think in the past the problem was that people were not aware about the tax arrangements to pay the debt with SARS. And we cannot run away from the fact that even though you are getting into a tax arrangement for the previous year, even this year you might be accumulated a debt that still needs to be paid. And if you get into a tax arrangement, again, it increases what you thought you would normally afford. Hence, we're saying, let us get into a meeting with the financial records clerk and the chartered accountant to help you to understand on how best you can do these things. The business has a process of recording and adequately responding to SARS correspondence on time. So what is happening is that correspondences are happening in two ways. You get a correspondence from SARS when you have filed the return, print that correspondence or save that correspondence, and formulate a response to it, okay, and respond. So there are three documents that you're gonna have. You're gonna have the return that you have filed with, it has got its own supporting document. Then you got a correspondence from SARS, you attach it here. Then your response to this correspondence, you also attach it here. But there are instances where the correspondence itself acknowledges what you have done, so it doesn't need a correspondence. But at the face of the correspondence, you just have to write and say, this correspondence doesn't need a response. It's an acknowledgement. I also am also conscious that I don't have to provide a reason for this one. Also, when you did not file a return, SARS might send a correspondence to you and say, don't forget. So that one needs a response. And when there is a dispute between you and SARS, there will be a correspondence which is fall in part one, because you've already, a dispute cannot just come without you sending something to SARS. So all of these must be kept intact, and there must be a register of all the correspondence that you have received from SARS. I just want to make sure that when we deal with the documentation in expenditure and taxes, we have a register of correspondence from SARS, so that we can understand what I mean there. All right, then that takes care of this page number 3. And says the business has a process in place to keep updated with national tax changes. Okay, SPPSA is there to help you with that one, because Tina, we're gonna track everything that is happening nationally and post it here. Inform your chartered accountant, inform you, because you'll be our member. Inform your FRC to say the government now is proposing this. There is a new VAT system that is coming. VAT is going to change. The VAT rates are going to change. This part of VAT is changing. Take care of this. The only thing that you need to do is to show that you have attended our CPD with regards to that. Or if it was not a CPD, it was a form of circular communication, you just have to prove to the chartered accountant that you have printed the circular, you have understood it, and it has got these implications to your business, and that has been recorded down. Recorded down, because here all what we want is the yes or no, and only 2 people are signing: a chartered accountant and the financial records clerk. And we already know now that the chartered accountant cannot sign a document that they don't know or that they have not seen. The business makes use of a SPSA monthly government calendar. We're going to talk to you about that. I think we said on CPD 1.6, we'll be going through that calendar. It's going to be a very short CPD, but I think instead of making it a separate CPD session, we're going to combine it with one of the sessions. Perhaps we're going to combine it with a value add statement. So we're going to show you what that is. All right, so don't worry about it. The entity is happy with SARS handling its affairs, yes or no? Because this one, we want SPPSA to register and say, what is our experience? What is the experience of our members with SARS? What are the causes of dissatisfaction, and what are the areas in which we want SARS to improve there? Number 4, that is disposing of the business. Pardon me. So when you dispose of a business, there are 4 things that SPPSA would want to know. is the business in a process of disposing the business in the next 12 months? Okay, you must remember that a business exists within a 12-month cycle. All right, all businesses, especially in their second year of operation, they exist within a 12-month of operation. So because we are using this document for the financial users, the people who want to make a decision about your business. So if you're about to sell your business in the next 12 months, tell them that this business I want to sell in the next. So the decision that you're going to make about it, you must know that it must last for 12 months, or somebody else, or it's going to be under the new management, or even if it's not under the new management, at least I won't be there. So you are telling them that. So it's like asking someone, are you going to be there at 1? Then the person says, no, I'm not going to be there. So you plan around that. All right, say, okay, so and so is not going to be there at 1, so this is what I must do. So because selling a business is not normally an overnight decision, it's a decision that is taken over time. So users of financial statements would want to know that the business is here to exist with you, or you want to part with it. So they want to understand that. So if you are about to sell your business in the next 12 months, what SPPSA would want to know is that, are you aware of the accounting and tax consequences should you dispose your business? So have you done research? Has your chartered accountant explained to you that now that you're in a business of selling your now that you're in a process of selling your business, these are the consequences that are going to follow, and this is how we should do accounting going forward. So it must not be a secret. It's something that we want people to talk about, because people sell businesses and you realize that, had this was planned properly, had certain decisions were taken on time, SARS could not have taken so much money from this business. But because the owner wasn't aware that there are processes that must be started when you're about to sell your businesses, and there are supporting documents that you cannot go back and find if you did not plan to do them adequately. So that advice is very important, and that's what we're trying to do there, because the aim here is for the small business practitioner to pay very, very small taxes if there's a need to pay at all. But if things are not done properly and without understanding, we're going to pay a lot of money to SARS. And we're not saying we don't want to pay money to SARS, but we're saying let us calculate our decisions properly so that we pay only what is due to SARS. The business has been valued to determine its current price by a registered valuer in the valuation cycle. Okay, I think this is volume 17, where we have introduced a valuer to say, if you are a member of SPPSA, you must get your business valued. Because remember, in a business, businesses eat a lot of time from us. We wake up in the morning, we go to the business, they stress the business is not doing well. We put money to the business because normally there isn't a lot of capital from the initial phase of the business, and that becomes an investment. All right, time that you spend in the business, sacrifices that you are taking for the business, and the money that you are putting in the business, the people that you are fighting with, the quarrels that you have, some of the people blaming you for this, and some of the things you don't even know that you actually did it. That is your investment. So someone must come and tell you that your investment is working, your investment is not working, and your investment is working with improvement, your investment is working without improvement, your investment is not working and requires improvement, and so forth. So that is why now we're saying at each given cycle, at least you must understand that my business last year was worth 40,000 rand, and this year is worth 50,000 rand or 120,000 rand. And what have I done to triple this amount to this? Can I trace the steps to where the business was up until this one? Because what is important now that you are in the business of you are in a process of selling your business, you cannot just value your business and say my business is 120,000 rand or it's 1.2 million, and that is known by you only. Someone independent must evaluate and say, no, the business is not 1.2 million. This business is 4 million. Here are the calculations that I've done to prove that this is 4 million. And someone who is about to buy the business must also be given that form of calculation to say, we are selling you this business with 1.4 million, and this is what we have done to come at 1.4. So you cannot just thumbsuck and say the business is 1.4. So that's what this part of the car is all about. The owner has a valid proof of ownership of the business. What SPPSA has done, they said, we understand that the CIPC is going to give you a document called a CK, and in that CK, there are directors listed there. But what SPPSA says, further than that, register with SPPSA as a shareholder so that we can teach you how to protect your share, how you get more information about the share, and that information comes in the form of a share certificate, which is issued once a year. All right. So the share certificate gives the detailed and the value of the business. Say this is how much my business is worth. So you can take, even if you want to buy something or you want to buy a car or a house or something, you can print our share certificate and take it to the bank and say, my business has been valued by a professional valuer who came up with this price. My business now is 2.4 million. I need a house for 1.5 million, and I'm making my business as a collateral. So that is why so far you cannot get that, and people don't know what type of advantages they have in the business, and how the business can work on their advantage. So we're trying to create those advantages there. Look on the scores. 4 questions, 3 are yes, 75, and no is 125. So it's not compliant. So SPPSA is saying here, there is no reason for this business to be 75% compliant. This business should have been 100% compliant, and the chartered accountant is going to sign there. So you can see that there is some form of emphasis on the broader knowledge of the business, all right, and what is expected to be done. Tax consideration, yes, there might be a difference between disposing taxes around the disposal of the business and general tax consideration. So the first question here, the owner is aware of the business tax season, all right. So this one is not difficult to prove. You just take a ball pen and you say, here is my year end. SARS has declared, this is which year is this? This is 2024, 2025. So in 2024, we're doing taxes for 2023, and SARS would have issued a notice to say, these are the closing. This is when the tax season starts. This part of the tax season relates to individuals. This part of the tax season relates to companies, and this part of the tax season relates to people, including professional taxpayers. So you would have identified yourself when we're dealing with tax category to say, okay, myself, I have to fall in this part of the tax season, and my obligation in this part of the tax season starts from this date and end with this date, and these are the things that I should have done. You can just write that down for the benefit of your chartered accountant, and show that you understand it. And if there are errors, your chartered accountant should be happy to correct those, so that you understand perfectly what your situation is. Because understanding your situation helps you to understand what obligations you have within a tax season, and it helps you to plan properly. Remember, we've been talking more about planning, and we've been saying if you don't plan properly, you are causing a danger to yourself of paying more to SARS, and that's not what we want. So planning starts by you understanding the situation, and understanding the facts, and understanding what type of supporting documents you must have on time. The sad part about the tax season is that you don't start to plan or get most of the documents during the current tax season. When you plan for a tax season, you normally plan for the next tax season, all right, but using the dates of the previous tax season, so that you are able to collect and package your documents correctly without a problem with SARS. The entity has a plan to adequately attend to its taxes and obligations without missing important dates. We've already talked about that because it's a process that you need to appreciate and understand that as a business owner, this is what I must do. You can also include it in your calendar to say next year at this time it will be a tax season, and you start populating your calendar to say I must watch out for this, I must watch out for this, or I must not remember, I must not forget this document and all those and all those. So it's a very nice thing. Can you say how SPPSA is making business much more professional, much more interesting, much more interactive, and much more involved? We are doing this for your benefit, of course. The entity has a plan to adequately attend to its tax season obligations without missing important deadlines. I think this one we have done. The entity understands its monetary tax fluctuations, and these are analyzed frequently. Okay, if you are paying different taxes, let's say you were the member of SPPSA in 2020, you paid 5,000 rand. 2021 you paid 8,000 rand. 2022 you did not pay. SPPSA is saying, have you put that trend into a piece of paper, and do you understand why in each of these years a particular tax was paid and why a particular tax was not paid? What is your understanding? Because it helps you to understand your business, and helps you to fit into your planning there. All right, because we want responsible and much more informed, professionalized small business practitioners. That's what we're trying to get in chapter 5. And the chartered accountant and the small business practitioner are going to sign there. Death taxes. The owner is aware of the process to be followed should he passes away. Remember, this can take many forms. We might have dealt with it in volume 2, taxation of married couples. Okay, what is important there, we've already mentioned slightly when we're doing with CPD 1.3, where we were saying, understand your situation perfectly. You are married, you've got kids, you are not working elsewhere, you've got business, and you die. You are working somewhere, you've got kids, you are divorced, and you die. You are working somewhere, you've got a business, you are not married, you've got kids, and you die. So what is your situation? So my advice to you is that you must get a tax opinion from a chartered accountant and say, look, what will happen if I die now? All right, what will happen if I die now? So the person is gonna test the tax consequences if you die now. But also, you must ask a lawyer. There is a lawyer that we're gonna involve in this chapter on death taxes, who is gonna explain to us what will happen when you die. No, we're gonna involve the person in chapter 11, volume 11. What happens when someone dies? Whether the person dies in town, let's say the person was a resident in town, or the person dies in the rural areas where the person was staying in the rural area. The business has got a succession plan. I was surprised when I saw SPPSA putting this question here, because this question sits predominantly with chapter 1, chapter 1 of volume 6. But I quickly realized that they are putting this question here to test what you have said in chapter 1, to say, are you consistent with what you said in chapter 1? So can you say now 50-50, yes or no? It makes 50 and 50 and you are not compliant. And SPPSA doesn't want that. So it means that you just need to get the process. The process is very easy. It must be explained in a form of an opinion, all right? And then the succession plan must be explained to you by a chartered accountant to say, how do you get a succession plan in place? Or otherwise, you must just state in your will that once you die, you want your business to be disposed. You don't want it to continue. Because even though we want businesses at SPPSA that are going to continue, we are not forcing people to continue with businesses when they find that the business will suffer. Because remember, a business is a person also who must not suffer. We've seen in many instances where people will include it in their will and say, in the event I pass away, the business must be sold altogether. I don't want it because it's going to create problems in my family, which is fine and good, and that forms part of the succession plan. Because what you are saying is that the business must cease to exist once you pass away. But there must be tangible evidence that is supporting the succession plan. What we don't want as PPSA, we don't want a business collapsing by circumstances, by virtue of circumstances. If you want to sell your business and you're conscious about it, then you can sell it. We don't have a problem. But we don't want businesses that end up not going anywhere because of a lack of knowledge. Then the chartered accountant is going to sign there and puts a date. And this date must be understood together with the date of the financial statement. So even though some business might not be signing this on a monthly basis, but this is a living document, and the chartered accountant and the small business practitioner should have this document at the palm of their hand on a continuous basis to say, how far are we with this? How far are we with this? Look, we're going to issue financial statements. The bank wants the financial statements for the interim. All right. So how this document works is that if you're going to issue management accounts that accompany financial statement, this document must be there. All right. Even if you are not going to issue management accounts, but the financial statements are there, this document is there. So it's read together with the financial statements, and the signature date here must be the date of the financial statements. Value added tax. The business has registered for value added tax, that is category A, B, C, D, or E. Now, there is, if you remember when we were talking about tax types recently, there is a tax type called VAT 201. All right. So VAT 201, you register it with SARS. You will see when we're dealing with it. VAT 201, you register it with SARS when there are two ways in which you can register it. Either you can register it as a voluntary, on voluntary basis, or you can register a compulsory on a compulsory basis. Compulsory basis means that one, you have met the 1 million. In other words, your sales have exceeded 1 million. Or you have gotten a contract with the municipality or the department or any other government authority that once entered to it, you will exceed 1 million. Then you have to register for VAT. Or you can register on a voluntary basis where you have exceeded 50,000 rand. There must be proof for all of this. All right. So once you have registered, make sure that you are registering on a correct VAT category, because VAT category then means you have to submit returns on a particular point. All right. So just make sure that you are doing that. I've picked up in a number of instances where SARS will register someone on a certain VAT category, and later on SARS performs an audit for that entity and later penalize them and say, no, you were not registered in the correct VAT category. Here is the penalty that we are issuing there. So again, your chartered accountant should help you with this one, and you can also go to SARS to verify if one, you need to register for VAT, and two, if you already registered, you are in the correct VAT category. Okay, we at SPPSA we have since learned that with VAT, it's also important, because VAT, any form of tax, has got two friends. Has got politics and it has got economics. So here we've considered that a business must do a self-introspection to decide, to say, for instance, let us read 7.2. The business has made enough effort to determine if they are price takers or price givers. We're going to talk about this when we're dealing with chapter 7. Perhaps let me explain what these are. If you are a lawyer, you get what we call a tariff book, a gazetted tariff book that states that this is how much you charge for each service that you want. You cannot charge beyond that. It means you are a price taker. You are taking the price from someone and implement it in your business. If you are an engineer, it could be that you are given also to say, when you are pricing, this is what you must do to price. But not every business is like that. For instance, chartered accountants. Chartered accountants before SPPSA could charge any price depending on because there is what we call vets and skills, to say this is how much time I've taken for this, and this is what I'm going to charge. It's normally not justifiable, really. But after SPPSA, we gave a portion of what chartered accountants and financial records clerk must charge. So if you are given how much you must charge, even if you want to charge more, you cannot do that. You are a price taker. But if you can tell someone and say, no, I've looked at the work and I'm going to charge you 50,000 Rand. This is based on time that I think I'm going to spend and my skills that I'm going to employ in me doing the job. You are a price giver. You are giving the price. And that has got different VAT consequences. We believe in that as BPSA. So the small business practitioner must make sure that they understand that. Because once they understand that, they will then understand how that affects their how VAT is applicable to them. Okay. The business is a process of determining value-added tax input. A value-added tax input, first, let us agree that you have already registered as a VAT vendor. Then when you buy from someone, you're going to collect what we call an input. But when you sell your product with VAT, there is what you are accumulating what we call a VAT output. So what we're saying at SPPSA is that if the small business practitioner is registered for VAT, he has been taught on what an input is and how is it made up. He has been taught on what a VAT output is and how is it made up. All VAT returns have been declared on time. Then there is a schedule from the system to say this VAT due at this particular point was filed at this particular point, and then there must be a tick to say this was filed on time. SARS has got a schedule to say you must. So if let's say you are on 1 month VAT basis and you file your VAT every month, so SARS says for June, if you're going to file a return VAT 201 in June, for June, that return must have reached SARS on the 25th of July, 2024. So a schedule must show us that the VAT for June was filed on the 16th of July, then the deadline was met. Was filed on the 29th of July, the deadline was not met. So the supporting document, the supporting evidence, there is the schedule, which is also signed by the chartered accountant also. But what I've seen other people doing, even if it's not signed, they just capture the information and take a screenshot or attach the statement of account for VAT. Because the statement of account will show you the date in which the declaration was made. But I think for purposes of simplifying it, having the schedule that specifies the date, because remember attachments are going to be used for something else. But for purposes of just understanding as a chartered accountant if the business is going well, and for purposes of educating the professional itself, you would then attach this document. The reason why we attach these documents, remember we are saying it as PPSA, Keep your documents intact, readily available, so that if someone else comes to assist you in your business, to run your business, he just takes the file, read the file, and voila. Voila means that the person understands how things are done in your business, when things are done in your business. Even if the person has not gone through the last chapter, that is volume 20, to say what are the processes, what are the policies, and what are the procedures of the business. By just taking a file and going through the file, the person should understand how the business is managed. Then the person will manage the business almost the same as you would have done, and will still take the decisions that you would have taken. Are all items are sold at a fair value? This question is linked to that question that we asked previously, to say, do you have a register of related party transactions, and do you have a register of arm's length customers? Because also it's going to help us to understand here if your declaration to SARS is accurate. So the chartered accountant is going to compare these two and make a reconciliation there. There is a process of keeping and accounting for all VAT related documents. Okay, that is the VAT schedule. Okay, the VAT schedule is going to help us to do that. We're going to show you the VAT schedule when we are dealing with the VAT there. The owner has access to e-filing to view and monitor VAT-related information. Remember, as it stands now, we have seen a lot of businesses with accountants taking charge of the tax and accounting function of the business, and the owner knows nothing about what is happening. So we're saying now, the owner must once a month take a screenshot of all the with the video. With the video. I think that's how evidence is done, with the video of him getting into the system and talking to say, okay, I'm in the employees tax now, I can see this and I can see this, I can see this. So there are pointers that we are showing, we are asking the business owner to mention, to say the employees tax is for this and is for that. I'm inside the platform, I can access my platform with my accountant or without my accountant. I can access my platform at home, and then all those things. And sometimes they can do this in a form of an affidavit from a police station. The owner has access to e-filing and monitors VAT-related information. Okay, we have dealt with that. The business is VAT compliant, yes or no? Okay, VAT compliant. I think the status in the status schedule for VAT must be compliant, and it must be green. The business is on a correct VAT accounting system. So there are two accounting systems. We'll deal with this when we're dealing with Chapter 7. So the first accounting one is the accounting basis, and the second one is the payment basis. We're going to explain what those are. I've seen a number of people forcing themselves into a payment basis, which is wrong, and SARS penalizes fiercely there. So you must make sure that you plan properly for the system, for the accounting system that you are in there. The business separates its transaction from personal transaction. So if you listened carefully on what we have said in CPT 1.3, in CPT 1.3 we said, whatever you do, separate a business card from a personal card. All right, so that we don't get a bank statement with Nando's, Chicken Licken, Pampers, pads, condoms. No, that is not right. So just take personal expenditure and put it aside, and take business expenditure and put it aside. So it's about you using your card wisely and effectively. So it's a yes or no here. All right, and I think this yes or no sends a very big message to the person one reading your financial information, because it could be that the financial information is not accurate, and it means that you are eating most of your money to yourself, you're not a disciplined person. So, but if you separate your business card from a personal card, it could well mean that things are going well. There is some form of discipline and management strategy there. The business claims only legitimate business expenses. This is an ethical question, all right? So you can answer that yourself. Okay, just want to get to that question correctly. Okay, we've done that. Okay, let us go to financing now. The business has got a capital finance structure. No, this is not a difficult thing. If you borrow 50,000 rand from me to start a business, you must register that in a loan schedule to say 50,000 rand was borrowed from Mr. Fuzani to start a business. If you deposit from your own money 50,000 rand to the business, you must write a capital schedule to say this 50,000 rand is coming from me. I am making it to be capital available. You will see this when we are dealing with revenue. This 50,000 rand, I'm making it available to the business. I want to start a business with it. So already now we can see that your capital structure is formed of debt, the amount that you borrowed from Mr. Fuzani, and the amount that yourself you've put to the business. So that's what we call the capital structure. So that must be known, and there must be that must be verified, and it must be traced to the financial statements. To say this is how much you brought yourself, and this is how much you have borrowed. The business is a process of separating finance funds from ordinary expenses. Okay, so when you get money as a capital or as finance, it must be separated. And when you pay a finance related accounts, for instance, if I'm borrowing you money, you need to pay back for it. All right. So, and when you pay yourself money, that is money that you have worked for. So these monies must be separated to say, remember when we talked, we said all the transactions that you are paying for must be explained so that we understand what you are paying for. Because if this separation is not happening, remember the confusion. For instance, now we might not know how much left of this loan you got from Mr. Fuzani. And what if Mr. Fuzani, after your death, says, no, I gave this guy 500,000 rand. He wrote 50,000 rand, I can see. But because of incorrect recording over time, might make you susceptible to that thing. The business is a process of separating finance funds from ordinary income. Remember, the bank statement will show credit if you are receiving money. But that doesn't necessarily mean that is all income. Remember, Mr. Fuzani gave you 50,000 rand and the bank statement showed the credit, money received. You sold inventory from your business. It was also money received. The bank statement shows income. But the money that you borrowed from someone is not income. The money that you received by selling good, it was income. And you classifying this amount properly, it helps us to understand and to formulate an opinion on how your financial statements are. The business finance options are appropriately covered by adequate document and are well kept. So if you're saying you borrowed 50,000, Mr. Fuzani, where is evidence for that? We can see the money that is in business that is coming through the bank statement, but what is evidence that it is a loan? Because what SARS doesn't want is for you to pinpoint all the monies that you have received and say these are the loans. There is no tax on the loan, but you benefit from reducing in fact from adding to the expenses by finance cost, and therefore SARS is losing. So SARS will want to understand more when you say this is a loan. All right. So every loan, every capital to the business must be backed up. The business is a financing schedule split between different forms of finance meant to track the financial options of the business. There could be a number of even though you might want to list this on the loan schedule, but a loan that you got from Mr. Fuzani perhaps doesn't have an interest, and and needs different supporting documents. A loan that you got from Standard Bank might have interest and needs and is supported by different evidence. So that's what we are saying there. That because it keeps you conscious to say what are your responsibilities to each of the loans that you have. Because even if you lump them in the loan schedule, you must have notes to the next to it to say this one, these are the conditions, these are the free conditions of the loan. So by doing so, you are helping the next person in your business to understand the responsibilities of the business towards these loans. The business have got payment calendar guiding all its financing commitment transactions. Okay, this will go to the business calendar we mentioned above, but only we need to say, remember we said all the payments, we need to identify what the payment is for. So when you include it in the calendar, you're also going to include the description for that one as well, so that we can trace all the payments of the business that is making at month end or at some parts of the date. So it helps you, the calendar itself helps you to understand the free zone. The free zone is the part of the month where you are free. Say, I've paid everyone. And also it helps you to understand the tough zone. The tough zone is where you really need money to say, okay, I need to have 50,000 rand between the 6th of the month and the 18th of the month, because I'm starting to pay people on the 20th, 25th. And from the 20th, 25th, the amount that I'm paying is 50,000 rand. So that's the tough part of the calendar. So we need to see all these transactions that you are paying there. All right. And also, if you are selling, there are services that are sold at month end. So it means that you're gonna group all the money that you're expecting at a particular date of the month. But if you are in a business of expecting money on each day of the month, we should say that on the calendar to say, on day 1 of the month, people have got money. I normally make so much sales. So as the calendar slips, you'll find that your revenue is declining, and we need to show that in your calendar. So in the financing schedule, they are tying it up now to that calendar to say, is your calendar well explained for someone else to understand exactly, or even for yourself to understand the operations of the business and to understand at which point of the month you are getting more money and which point of the month you are paying more. And of course, we're going to include the reasons for that. Okay, shareholder information is well kept. Then shareholder information, it's when you say, I'm the shareholder of the business and I'm giving the business 50,000 rand. I'm not going to take this 50,000 rand back. It's my contribution to the business, and that information must be reflected in your shareholder certificate. Now, remember, from the beginning we said there must be a capital structure. I just want to show you this. There must be a capital structure. And the capital structure, we said, it's shareholders and finance. Finance is the amount that you have borrowed, and this is the amount that is coming from your shareholding. All right. So we have analyzed from 8.2 up until 8.6. We talk about what information do we need to support the amount that you have borrowed. Then now, SPPSA from 8.7 to 8.11 is talking about the amount that you gave to the business as the shareholder, the amount that is coming from your coffers. All right. So they are saying the shareholder information is well kept, the register for the shareholders is there, and the share certificates are well organized. In other words, they are verifiable, yes or no. So don't worry about the fact that the one question has got many questions in it. That is strategic for SPPSA. But all you need to do is to make sure that you say exactly what is happening in your business. So if there is one question, let's say there are 3 questions. One of the questions, for instance, here it says shareholder information is well kept. You can say, yes, my shareholder information is well kept. The register is not there, and the certificate are well organized, and the share certificate are well organized. So there's only one thing that is not there as we speak, is the register. So the answer is no, because it did not meet all the requirements of the question. Okay, 8.8, Shareholders of the business are appropriately trained on a regular basis, so they just need to join as shareholders of the business with SPPSA, because at SPPSA we then give the training about shareholding of the business. Directors are appropriately trained on the lending requirements and obligations. So because we're talking about money in this volume financing, so if you are a director and a shareholder, so there is a training that is meant for both shareholders and directors, but there is no worry if you are a shareholder only. You can still benefit and train. So you just have to register with us as a shareholder. That training is happening there. The business keeps appropriate financing register. Of course, we've already talked about it, the loan schedule, okay, with explanation, dates, and also it's a very nice, informative register that tells us that this money was received at a particular point, this money is for this money is from this person, this money is paid in this way, these are the dates in which this money is paid, and so forth. So that's what SPP is. Can you see now? We are not joking when we are saying business. You cannot just jump into business. There's a whole lot of things that you need to understand and the reason for that. And what is nice about SPPSA is that once you have been taught about how this works, you should be able to go elsewhere and tell someone. Can you see now we're creating that nice language? We're creating something to talk about, and we're talking about something informative and educational for people to move forward in this structure of doing things. The company accurately classifies the income statement and the balance sheet item in dealing with finances. Okay, with finances, okay, it's obvious, but it's important for the education of the small business practitioner that when you pay a loan, you normally pay three things. You normally pay transaction cost, penalties, and interest when you did not pay on time. Then you pay finance cost and capital. Remember, if you take a loan for 100,000 rand, the bank will tell you that we're giving you 100,000 rand, but this 100,000 rand, as you're gonna bring it back over here, you're gonna bring it 120,000 rand. So the 20,000 rand is finance cost. That's what this part is all about. Is the small business practitioner aware that the 20,000 rand is finance cost? Is the practitioner aware that the 100,000 rand is capital that belongs to the bank? So the bank wants what belongs to it on the 100,000 rand. Then the 20,000 rand is profit for the bank. Then if you miss a payment, you're going to be penalized. Transaction costs, reallocation costs, then those costs must get to the other line items of the income statement. But what I've seen that is that some businesses will normally compound those on finance costs, which I don't entirely agree with it, but it's well and good because at least it has been reported. So what is important is that it helps you to understand now and make a meaningful understanding of your bank statement and see now how your monies flow nicely to their respective lenders, and it helps you to plan, and it helps you to understand what is eating your money and where most of your money goes. So it helps you now to have a monitoring structure in your business. I think this is one of the good chapters. Then depending on the number of yeses or no, you write it there. Look here, there were 11 questions and 10 are yes, which is 91. Only one is no, so it's compliant. So this one must be explained in schedule 11. In part H of the financial statement. Then once that has been done and a meeting has been set between the chartered accountant, the financial records clerk, and the financial records clerk, then the chartered accountant and the business practitioner are gonna sign there. Okay, assets. We're gonna get to assets chapter 9. Okay. The one of the problems, I think I understand why SPPSA is raising this question. They are saying the company have a plan to deal with assets that are in the possession of its employees. mostly this is happening in the firms of accountants, where you'll find that an employee is given a cell phone and is given a laptop and is given a data card, you know, and you'll find that this is not recorded anyway, because there is that trust relationship to say, no, this guy is coming back. We once had a problem where one of our employees, we couldn't afford salaries that month. Then the employee said, no, I'm not coming back to work. It's fine even if you didn't pay me. I'm going to just take the laptop with me. I'm not bringing back the laptop. And that is wrong. And even if the employee doesn't bring back the laptop, but the laptop must be registered in the books of the firm, and it must be allocated to say this laptop with this serial number, and you take a picture of it, is with Mr. Fuzani. So it helps us, even if Mr. Fuzani is no longer coming back to work, we can say, okay, this laptop is not inside the premises, even when we are doing stock taking, and it is with Mr. Fuzani. All right, so that nobody comes and say, my laptop was here, I cannot find it anymore, and that is wrong. So all the assets that are attached to the employees, those assets are at a danger of getting lost. So I think I understand SPPSA here. So those must be recorded like that. All assets are supported by relevant document and supporting their existence. Of course, when you buy an asset, keep the slip. When somebody donates an asset, keep the slip, and that must be recorded down, all right, for all the assets. So as you put your asset in the fixed asset register, there is also what we call an asset list. You start by an asset list where you record the asset, who the person is holding it, and the notes next to that asset register. So, so if the asset was not bought, it's gonna be registered on the asset list. If the asset was bought, it's gonna be registered on the asset list. Then the information about donation dates and all those things, they're gonna be on the asset register, and the two documents must talk to one another. The assets must be barcoded to the extent it is possible. All right, all assets must be included in the asset register. So there must be an asset register. All financial assets are included in the asset register. So it means that the asset register is gonna start with. I think it's gonna be a very interesting chapter to deal with the asset register. It's gonna start with the finance assets, then it's gonna come to the tangible assets. So on the finance assets, for instance, if my business has got 50,000 rand and I'm desperate to do something, I can borrow myself that 50,000 rand. We call that a finance asset. Okay, so I am owing the business 50,000 rand. So the business has got an asset of 50,000 rand from me because it is expecting 50,000 rand from me. So the SPPSA is saying that we must not forget to register those finance assets, because the employees might get away with it. And it says that, okay, once you have understood that you've got finance assets and physical assets, split your fixed asset register like that. And it says there must be a company asset management policy to say this is how we are going to manage the assets of the policy. I think that policy weighs a lot, because it means that there has been a careful determination of how the business intends to manage its assets there. So the policy itself can be drafted in a number of ways. Although the SPPSA wants to see this on chapter 9, you might talk about it in chapter 9, but you might want to include that with one of the policies that are dealt with in the last chapter. So it might be in your policy schedule. The company has a plan to deal with obsolete, I think that is obsolete and redundant assets. Okay, the printer is no longer working, it's sitting there, it's gathering dust. What are you guys gonna do with that? I've seen a number of instances where you get a printer, the printer is financed by a bank, and over time there's a problem with you and the bank. You are no longer honoring your payments, and the bank just leaves the printer there. What do you do with that? Do you sell it? What do you do about it? And what do you do with assets that are no longer working? Here is the heater sitting here. Here is the kettle. Here is the microwave no longer working. Here are the earphones. Here is the charger of the computer. So the storeroom is very bulky because there are a lot of things that are inside and they are not used. So I think 9.6 and 9.7 should talk together. All right, but even if 9.7 is included in 9.6, if there is a plan in a form of a policy, then there's also a yes here with that one. So it's just an additional unnecessary point that SPPSA is giving them. Is there a depreciation policy in place? Yes. Although I've realized that the depreciation policy, most accountants don't understand at what point, from what point to what point will it work. And the nice thing now, we've got a business valuer who's going to help us to value assets that to value assets that are falling outside the depreciation policy. The business has a plan to resolve assets that have reached their useful life. I've already talked about that when I was talking about the business valuer. The business have a plan to deal with prepaid assets. Normally, what happens when you pay for a service that you have not used? You're still gonna use. For instance, as an accountant, you find a client that says, "Okay, Mr. Buzana, how much are gonna be your services over a year?" You say, okay, this service is going to be 250,000 rand over a year. Then the client just pays you 250,000 rand at the beginning of the year. You have not worked for that 250,000 rand, and it's not yours to the extent that you have used it. The people who will explain that more appropriate to you are the lawyers, but accountants can still have can still have a good documentation management there to say, how do you account for money that is paid to you on a trust basis, because this person trusts that there's not going to be a problem between the two of you, and pays you for 12 months worth of work within the first month of the month. And remember, at that time you are being paid, you have not worked for that. So it means that you need to spread the work over a period of 12 months, and you're going to earn from that work over a period of 12 months. So let us say your financial year ends on the 31st of March, on the 31st of December, and the client pays you 250,000 rand on the 1st of January. How do you get that money over a period of 12 months? And where do you put, for the 11 months that you have not worked for, where do you put that money? So that is that prepaid asset there. And how do you update your balance sheet and your management accounts with regard? So can you see that this is a conscious process? It's a conscious decision making process. Are the asset continuously checked for impairment by the valuer? I think that is a valuer. So what you need to do now is to say, are the assets intending as they are? For instance, you'll find that in the office we once had a printer that was printing black and white, but now it's only printing black. And even though the cartridge for the color is there, but it doesn't select it and prints black and white. The printer used to print 4 papers, A4, A3, A5, and A6. But now it's only printing 2 papers, A3 and A4. So that is an indication of impairment, and only a valuer can do that. Okay. So, but the valuer needs to find and to make use of alternative procedures to make sure that even if he's not there, he can still capture those assets, and we need supporting evidence for that one. So 9.2, the business has a list of asset schedule. Okay, so we've already talked with this one when we were talking about the asset register, because we said before you get to the asset register, you must have a list of assets first. So that one has been dealt with. I'm happy that SPPSA is not making that assumption, but they clearly want to see the asset list. Asset brought by the entity but used employees are appropriately accounted for. Okay, there is an entity I know where the owner of the entity could not afford to buy a microwave. So he asked one of the employees to buy the microwave on his behalf. And the employee bought the microwave for 3.2 cash, and of course was refunded. But now the only difference was that at the point of sale where the microwave was bought, the seller wanted to know the details of the person who was buying the microwave. So it could not be registered on the name of the employer because he was not the one who was. But that one can be closed off by doing a joint affidavit between the employer and the employee stating that fact. All right, to say I bought the employee on cash. My employer is gonna pay me over a period of time, but I was buying this for the employer, and the microwave belongs to the employer, and I don't have any ownership of the employer. Then it will fall in the asset register of the employer. So we just have to be conscious about that one. Can you see how we're developing our asset register and what information are we giving it to there? So it becomes a very nice experience. So there are costs that are associated with our assets. So every cost that we incur in relation to the asset must be registered on the repairs and maintenance schedule to say we incurred this cost for the door, we incurred this cost for the microwave. Somebody was repairing the microwave with a barcode so and so. So when we are dealing with the repairs and maintenance schedule, it must be detailed enough for us to trace the cost so that we can understand that no, it's no longer worth it to keep this microwave because look at the cost. The cost have exceeded the price of buying the microwave. We must just dispose it. And if we're disposing it of, that information on how we dispose the microwave must be, or any asset for that matter, must be included in 9.6. The entity accounts appropriately for the disposal of assets and remove. So if we disposed of an asset, what does our asset management policy says? At what point do we remove it from the asset register? Because once you have disposed it, it means that asset is no longer yours. So you must have a process of taking it out from the asset management policy, from the register, and what is the process of taking it out? All right, the accountant is gonna help you. So it's a yes or no situation there. So you can see SPPSA really puts so much emphasis on assets because they really want to understand when you're producing financial statements, what is it that you have and what is it that you don't have really. The entity accounts properly for all its disposal. Okay, we've talked about that. The asset register separates between owned asset, finance lease, and operating lease. Okay, so these are three categories of assets. There is an instance where you take 10,000 Rand and you go and buy a printer, then that becomes the printer of the business. But there is an instance where the banker says, look, I'm going to buy a printer for you worth 50,000 Rand, but you're going to pay me 1,500 a month for a period of 36 months. And then the printer is going to be yours on the last installment. Then that is a finance lease. But the banker can say, look, we're going to give you a printer for 1.5, but when you no longer need it, we're going to take it back. That is an operating lease. So in the asset register, we need to understand which assets are yours, which assets will never be yours, and which assets will be yours over time by just looking on the asset register, because that helps us to understand the information that is on the financial statement. I can imagine what SPPSA is trying to do here. They are trying to conscientize practitioners about the classification and the financial implication of each classification there, which is a good thing. It's a good thing indeed. Depreciation is correctly accounted for in all financial statement components. Okay, the reason why 9.16 is important is not to inflate or underestimate depreciation, because if you don't understand your assets correctly, to say in which of my assets am I able to calculate depreciation. Remember, you also have financial assets which you cannot calculate depreciation. So if you just calculate depreciation on values, you are likely to have problems. And SPPS is trying to conscientize that when we're calculating depreciation, we must make a conscious decision for us to arrive on what depreciation is. Then the chartered accountants is gonna sign there, and the small business practitioner after the meeting. And look, that is 91% of the yeses here. So this complies. So this 1% must be explained to say, how is the entity gonna? I think the combined reporting annexure can work well if it gives some time. For instance, my imagination is that now that SPPSA has issued out this version, at least it must take 2 to 3 years like this. Or even if it doesn't, it must have just it must have minor changes, because what SPPSA is saying, they are giving a contract to its customers to say, we want you to work towards this. And if they are changing it rapidly, or on a fast paced speed, they might lose the focus. So for me, I think this must stay like this for at least on a 3-year cycle. So after 3 years, then they revise the version and it becomes version 2. And when they're going to revise version 2, they must do that even a year before it's applicable, so that it helps people to understand and to revise on time what changes are going to be there, so that they are able to match this version 1 and what this version 2 is going to be. All right, I think now that takes care of this part of assets. Now, employees of the business, we've been talking a lot about employees of the business, but because we want to deal with Department of Labor, this side of the value plan, we now go into chapter 10. Chapter 10 is about employees of the business, and SPPSA is very specific, and they are saying all employees have employment contract. Okay, there is no employee that is here without an employment contract. So we've got basis of reference. You can see that it's becoming tough now to operate a business. You don't just take someone and put that person there. You take someone, you sit down, and you do an employment contract. And an employment contract has got its own tenets. It's gonna explain. It's gonna explain a lot of things. And of course, when the employment contract is there, it's subject to change. And SPPSA is asking that the entity has got a plan to update the employment contract to deal with changing employment conditions, because you'll find that somebody was employed as a receptionist and now is a manager of the business because of that trust between him and the employer. But the contract is still reflecting him as a receptionist, and SPPSA doesn't want that. And that's where now guys with business management and SIX and the guys who have started business management have got an opportunity in the small business environment to come in and help the practitioners to deal with these ones. Can you see now we're making small businesses professionalized, and we're making them bigger because of the compliance that needs to be there and the understanding that is required in managing a business. I'm sure by now you are happy as we are to say, no, running a business is not just about running a business. There's a lot that needs to be done there. So it's a conscious process. It's a career now. We're making it a career. With what we're doing, we're trying to inform people to make adequate and informed decisions to say, is this what they want to do? And if this is what they want to do, they must expect to have this type of knowledge, because the industry is expecting them to do and to achieve certain things, and which is nice, because there's no way you can just get into a small business and leave whenever you want. So it becomes a process, it becomes a conscious decision to do it. It's an informed one, it's an interactive process. That's what we're trying to do there at SPPSA. The company has a plan to correctly account for the recruitment cost. Okay, that's not a problem. But you need to understand to say, what have I incurred to get a certain employer into working for me? And if there are costs attached to that one, phone calls, payments to this and this, they must be recorded down. SPPSA does not compromise for that one. Because if you say no, it means that we've got a problem with your employees, as you recorded them in your income statement. We can't tell if they are correct or not. The company has a plan, a process to deal with employee complaints and grievances, okay? That can be dealt with a complaints and grievance policy. A lawyer can help you with that one. All we need is evidence that when there's a problem at work, the employees do not struggle or in determining what to do. The company has a proof that all employees are registered with the Department of Labor or SARS for UIF. He's talking about UIF, all right? So what? So the I think for me, this can be done in a number of ways, but I always prefer that the employer must register with the Department of Labor for UIF, even if they are gonna pay UIF with SARS, because with that you get to register your employees with the Department of Labor, so they are known with the Department of Labor. That process is there with SARS also, in a form of you're gonna pick it up with EMP 501. So if you don't want to register with labor, that is fine, but make sure that your EMP 501 is correct. So that becomes a supporting document there. The company have a plan to process or register with that one. So when we track EMP 501, we can see which employees are no longer appearing and which employees are still appearing. So the employees that are still appearing, it means they are not deregistered with SARS. But what is important, or labor, what is important is that once employee leaves the business, there must be a schedule. You will see when we're dealing with COIDA, that it makes life easier there, because when you're dealing with COIDA, you calculate COIDA per month when the employee was still employed. So once the employee leaves, there's no calculation for COIDA, and it tells you from that moment when did the employee start working and when the employee left. So these documents must be coordinated properly, okay? The EMP 201 calculation, that is figure 5 and figure 9, and figure 35 of employees tax, that is 501, and figure 8, that is the COIDA calculation. So when you put these documents here, you must be able to come up with reasonable answers and supporting document for that question. The company has a plan to assist employees to get their beneficiary when they resign, okay? What I've picked up is that we don't know who to contact when we cannot find our employees. We don't have a contact list. Even when the employee is not coming to work, we don't know who to call. So what they are asking here is that for safety of the employee, for the welfare of the employee, know that it's not all about resignation. I think for me it's about wellness of the employee, to say, do you have who to contact? Because some of the employees just leave the business, and some of the business have got employment benefits, and we don't know what to do now with the money that we need to give this person, because he has accumulated this money for so long. So we need to contact someone. So it means that, because remember, as we talked about expenses earlier on, so we need to have a schedule that deals with employee contact information as well. That's what SPPSA is saying there. The entity is registered with DOL for CF, death and injuries at a workplace. So if you are a business, you register with COIDA. I've talked with COIDA. There's a way of calculating COIDA, and COIDA help businesses to cater. For instance, in one of our clients, thugs just got into the business and shot 2 staff members dead, and they took money and they left. So what's going to happen to those employees who were shot dead? Because they were at your premises, they were working for you. So their families are going to need compensation. How much can you value someone? You don't know. But if you have registered those ones, you just submit the claim to Department of Labor, and Department of Labor pays for those families, and the end of the story. But if you did not register for the employees, then it becomes your problem, and you will die you will die paying those families. And some of the families can be really bully, especially when they see that your business has been done recklessly. And SPPSE, that's what they are trying to solve there. The company has the most recent proof of payment for its CF. The CF is paid between on the 1st of May and the 31st of May. And Department of Labor is going to issue with an invoice. And once you have received that invoice, you must pay. And once you have paid, you must clip for that and you must register it on your DOL CF register. The entity registered for SARS for EMP 1501 and are closed on time. So the EMP 201 is the EMP 201 that is done on a monthly basis. So if you have employed someone on the 1st of January, you must close an EMP 201 for that person between 1st and the 7th of February the following month. All right. So the 501, the MP 501 is just to reconcile the taxes of the year. SARS wants to understand whether the tax that you have been paying to them on a monthly basis is the correct one. And if it's not the correct one, we adjust the EMP 501 for the correct taxes. The correct taxes could be more taxes or less taxes. All right. So there must be, those two documents must be closed on time, and there must be documents to support them. So you can say that SPPSA is really looking into a good governance of employee records there. That's all what it is. We've already talked about number 11. The entity has a process to determine the accurate COIDA. This is at SPPSA. This is done using figure 5. All right. The company is set up in date with payment. Okay, let me read that properly. The company is up to date with paying for UIF employees. I think the reason why they are putting emphasis on UIF is that sometimes some of the employees get sick and they need to resign, or they get terminally ill and they cannot come to work. And the process in South Africa is that when that happens, the person must go to labor, and some of the ladies will need that money, especially when they get pregnant, and labor must find them in their records. All right. I'm sure you have seen recently on Cutting Edge where we're shown a situation in the Department of Health in Gauteng where securities stayed outside for months, sleeping outside the building because some of the contracts were terminated, and the employees there were deducting UIF and were deducting Provident Fund. And it later on transpired that the employers were not paying over the UIF and the UIF and the Provident Fund. And that's what SPPSA is trying to cut there, is forcing the chartered accountant to ensure that whatever deduction is made, whatever statutory deduction that is made by the employer against the employee must be submitted for payment. The company pays for SDL as well, so there is a calculation on figure 5 that is done for that one to make sure that the entity, as it grows, it pays for all its respective obligations there. The company takes into account a 7th scheduled benefits in determining salary for the employees. So that is a very difficult one, especially if you don't have income tax from university, because there we are saying, in addition to the cash that the person is given, is there any other value the person is deriving from the business? For instance, you'll find that in some businesses like lawyers, the person is given a company car to travel with, so he can take the company car from home to work, and from work to home, and there is no accounting for that. When there is an actual benefit that the person is getting from the company car. In some instances, you find that the person bought a car using a company bank statement, but the person is driving the car freely, and there is no tax implication for that one, and that is wrong. And you'll find that the person bought a house using bank statements of the company and the financial statements of the company. And if you bought a car, a house, or anything using the financial statements and which were supported by the bank statements of the business, it means that the car is not yours and the house is not yours, or that item you bought that way is not yours. And therefore there must be a process of determining tax, or that must be paid by you to SARS. So that's what they are trying to say, is the employer conscious that with the added benefits other than the salary, cash salary, there is tax that must be paid to SARS, and that tax is indeed paid. It's a yes or no. All right. So I think it helps us then to go back and say, okay, what has been bought? Remember, you've got the asset register. The asset register is going to tell you what has been bought by the business and what has been bought by the owner. Finance lease, how was it financed? To whom this asset belongs to. Then from there, you are able to calculate the fringe benefits. So you can see that there is some form of relationship between the assets and chapter number 10, that is the employees. All employees are paid in accordance with the minimum wage schedule. Okay, no, according to the minimum wage legislation. So what is important now is to print the minimum wage and say, and decide what the minimum wage says. It says 3.5. Then you check everyone's salary to say, is everyone paid according to the minimum wage legislation? Yes or no? All right. So that one is going to help us. So I think this question is a legislative question because it's going to help us to understand how far the entity adheres to the laws of the Republic. The business does not have or did not have any government tender. I think the reason here is that yes or no, because once you say yes, it did, then I think the next question is to understand what type of employees were working in that government tender. Could those have been permanent employees, or those were just temporal for that tender, and how that affects some of the calculations that were included above. So if those employees were employed for a specific purpose and they did not pay UIF, SDL, they were not included in the calculation of pay as you earn, they must be drawn out and they must be included in a separate schedule, and that explanation is given. All government business pay on time. I think here, I think because of this question on top, we want to understand if you have a tender from a government department and you worked on the government department, but the government department did not pay you on time. That can justify why you've got outstanding returns for pay as you earn, for UIF, for COID, and all those things, because you don't have money. So it's a justification question. The way I understand it. Employees get their payslip on time, so that so evidence on that one is a payslip register where each employee signs to have received the register. I mean, to have received the payslip, where the payslips are issued manually. But there are now systems where you realize that the employer has gotten into a system where the employee gets to the system and prints the payslip themselves. So if that is the case, we will need an affidavit confirming that the employee has bought a system of this nature, and these are the capabilities of the system, and we get an affidavit from one of the employees who attest that the system indeed does make available that feature. The company has a policy, has an effective disciplinary policy, okay, that a lawyer can help you, because there are a number of transgressions at work and you don't want to to get stuck on how you deal with it. And so this question can be dealt nicely with the question about the grievance policy, and they must be integrated so that there is no issue about what must happen when someone has committed a particular offense. And we must not uh, vary our sanctions. This employee stole a cup, he was asked to pay 100 rand, and another employee had stolen a cup, he was fired. So the disciplinary proceedings policy helps us to cater for those differences. The company have a policy to deal with staff leave. Okay, we're gonna see how staff leaves are important and how they affect accounting. Some employees don't even report that they are not going to come for work, and the leave policy must deal with that to say what will happen. How do you take your annual leave? How do you take your sick leave? How do you take your family responsibility leave, your maternity leave, your paternity, etc.? There are a number of leaves that the entity might have, and they all have accounting implications. So the fact that you have that policy is going to help the accountant to formulate good accounting procedures. But if you don't have it, you'll find that there's a disjuncture now to understand how the accountant has arrived at a certain figure, because there is no policy. But if there's a policy there, then the accountant is going to help you to put costs on those ones, and that must be communicated to the employees as well, because the employees must understand how much each leave costs the entity, and how the entity deals with that one. It's a very nice comprehensive chapter. Chapter 10, we're going to deal with it when we get there. The entity have a schedule used to calculate leave for each employees. Okay, so there must be no issue to say how many leave days you have left. Okay, some of the systems now they reflect that on the payslip, but the schedule and the payslip must talk one language, because sometimes the payslip is not updated on time on what has happened, because sometimes you find that the employee has taken leave, but because there was this tender or there was this big event that was happening, the employee said, no, don't take your leave, I'm going to pay you for that day. So on the system, the person has taken leave, but there's a payment for that one. So that's what we're trying to solve there. The employees are well aware of what to do on emergency situation. Is there an emergency situation plan in the institution? Okay, and based on your understanding of what can be emergency, does it detail every situation and how long, for how many times it has put into test, and do the employees understand what to do? All right, so because the aim here is not to find the business not moving forward. Okay, so once employees find themselves in that situation, is there a plan that's gonna relieve them on what they should do moving forward? The company have a policy to deal with leave purchase. I think I've already talked about that one, to say, okay, I'm due to take my annual leave 5 days. I want to take five days, but the employer wants to buy the 5 days. They say, no, we're gonna pay you the 5 days. Don't go for leave because we need you. So instead of going, we're gonna compensate you for your leave. So the entity has got an appropriate employment equity plan. Okay, we're gonna deal with that to say, according to the South African law, we need to have 1 Indian perhaps, 2 Coloureds, 3 Africans. They will need to have 25 males. We're gonna need to have 50 males. So how far is our entity towards that? An entity employs foreign national, yes or no? Because there is this thing that South African employers exploit the foreign nationals, exploit in the sense that they are paying them less than for what they deserve. So once you say yes here, I think there are going to be more questions as to whether that employee is treated fairly like any other employee of the business. But I can see SPPSA did not expand on the foreign nationals, but we need to check also volume 1 SPOG to say, are there any questions that are there that are talking about foreign nationals? Because that can help us to substantiate it. But SPOC is an internal document, all right, which doesn't go to the users of financial statements. But I think for SPPSA, it's enough for the users of financial statements to understand that the entity has got a mix of nationalities in its employer. All right. So then the chartered accountant and the small business practitioner are gonna sit down in a meeting together with the financial records clerk and rate that one and see what goes to part H of the financial statements. Okay, revenue is another important factor in the financial statements. I've seen quite a number of mistakes made by accountants here when they are determining revenue. And I was very excited to see that SPPSA has included revenue again here. Okay, so the company has got a revenue policy. Yes, that's fine. So it means that we are all in understanding of how the company charges and accounts for its revenue. That's good. The company uses an invoice for all the sales it makes, whether cash or credit. There is an invoice. So if it's cash, you first issued with an invoice, then you pay, then you're issued with a receipt, then it's done. All right, so that is good. So if it's only credit, you are only gonna be given an invoice. All right, because an invoice helps to track the customer amount owing to the business, which is a good thing. The company has a process or plan to deal with debtors balances. Okay, some companies have got a debtors balance policy to say we don't allow customers to exceed a balance of 5,000 Rand a month, depending on what they are selling. We cannot sell to this person anymore unless the person reduces the balance. So if the person decides to reduce the balance by 3,000 Rand and doesn't pay the account off, we can still sell to them. But if the account is already at 5,000 Rand, we cannot sell to the person anymore up until the balance has been reduced. The company have a sales policy which includes a sales mix. Okay, a sales mix policy is saying, okay, we have decided to both sell on credit and on cash. So what is the percentage of our sales that are in cash? What is the percentage of sales that are on credit? And how is that managed? That's what they are saying there. Because remember, with all that has to be paid, pardon me for that, with all that has to be paid, it looks like companies need to have cash to pay. So you cannot have a very high credit sales policy. It means that you won't meet your cash flow obligations. So that policy is to conscientize the SPP, the small business practitioner, to say when you are setting up your mix, you must be aware of what you need to pay later on. The company has a process to calculate an accurate revenue amount. SPPSA has got a formula, a decision tool that we use to do that. The company has got a process to separate other amounts from its ordinary revenue. We've already talked about this when we're talking about finance, and we have a schedule that is going to help us to deal with that. The company did not understand some of its revenue in the current year. The schedule is going to help us, because the biggest problem that we're having in South Africa now is that, especially in the construction sector, or of number one, all other sectors are affected. You find that when the entity has to submit to SARS, they are going to go to the accountant and say, hey, please reduce my profits. Then the accountant reduces the profits. Then they submit to SARS. And sometimes they even go to the extent of registering a loss. All right, when it's not true, the entity has made huge profits. Then they reduce that amount. Then when the entity wants to take a loan from the bank, they go to the accountant and say, hey, please improve this profit. Then they improve that profit, So normally the best way to do that is to play with revenue and to play with cost. If you want a loan from the bank, you increase the revenue, you decrease the cost. So it means that the financial statements are not accurate. So if you're submitting to SARS, you reduce the revenue, you up the cost, so that you show low revenue, you show low profit there. And SPPSA is trying to stop that and say people must have one set of financial that are going to show their performance, to say this is how we have performed, and for the people to grow from there, growing up. So there must be no variations. And what is funny is that accountants accountants who do that have not picked up that each time a client is asking you to move move the financial statements up or move financial statements down, there's a cost. You can charge the accountant, you can charge the client for doing that. So there are a lot of costs that are involved around that area, and sometimes you'll find that people are not aware of how much they should charge around revenue variation there, or financial statements variation. Revenue reconciled to the output and output. Okay, remember we talked about when we're dealing with VAT, we talked about input and output. So here we're saying, now that you have calculated the amount that you need to pay or that is due to you from SARS on VAT, is there a way in which that VAT schedule is used to determine revenue? So do they collaborate? So they are not used in isolation. That's what SPPSA say. Be conscious that if you are registered for VAT, this is how your revenue will be affected. This is how your cost will be affected. There is a process of separating between capital and revenue sales. Okay, there is a schedule that is going to help us to do that. You will see when we're dealing with revenue, on what type of thinking do we apply in our minds. The company has a policy to deal with prepaid income. Yes, because remember, when we're dealing with I think it was assets, we had a prepaid asset there. All right. So now, what happens when someone pays on time, before time, or what happens when we pay before time? All right. So someone paying for the amount that we have not earned, how do we deal that in our revenue? So our schedule is going to help us to deal with that one. The company has a policy to deal with payments from customers for prior year invoices. Okay, so remember at the beginning we asked if the entity is issuing an invoice for its sales. Okay, there it is, question 1.2. So what normally happens is that hence we need experienced people. What normally happens, we'll find that the client is gonna come this year and buy for our accounting services. Boom, here our accounting services, they are 142,000 rand, 2023 financial year, but the client does not pay that 142,000. Remember, in our income statement, that 142,000 is there, and when we calculated tax for 2023, that 142,000 is there. 2024, the client pays 142,000. So the confusion there is that you'll find that again that 142,000 is taken as income, and tax is calculated on that. Okay. So SPPSA is trying to stop that, to say be conscious, track your invoices, and remember when we were dealing with I'm not sure which chapter was that one, whether it was chapter 1, where they said for each customer you must have a record of what has been paid, which invoice has been paid, and how much has been paid, and at which date it was paid, because they are trying to control the taxes the business may make. Because these mistakes of not carefully consider how much you are earning and how much you are paying can cause you to pay more taxes to SARS. So revenue is one of the areas where these mistakes are happening as well. Because remember what we said here, we said the ultimate goal is to control revenue figures, to say want to teach you to understand exactly how much you must report in your financial statements as revenue. At the same time, as you are dealing with this in pillar number 5, we need to teach you how to extremely determine your costs, because some of the businesses are failing because there wasn't attention to deal with costs. Okay, all documents relating to items of revenue are in place. We already talked with that when we were talking with chapter 1 to say we're gonna gather our documents there. There is a customer complaints process or mechanism that is very, very important to say, because remember, you had this mechanism when you were talking about employees. And also customer complaints help you to improve the services, and they help you to identify areas which can bring your business down. So this question, I think it's more of an affirmative question to the reader of financial statement to say enough processes are in place to secure and to continue with the client, which is a good, because I think for me, as far as I've existed in the small business environment, I don't think there's a problem with getting a client at all. You can get a client at any time. But what has been a problem, which I also have seen from other clients as well, was to how to keep the client yours. I think this part of the question addresses that. Okay, inventory. Not all businesses keep inventory, but you will realize that there is, a portion of inventory that is there. Is there an inventory policy? Yes, because inventory policy will tell you on how to deal with the inventory. Is there consumable policy? Sometimes some entities, they have got an inventory and consumable policy that is going to deal with those two. It's not a problem. When we're dealing with this chapter number 12, we will show you what is inventory. We'll show you what is consumables. The company uses a periodic inventory system. Okay, what system is the company using to account for its inventory? Yes or no? The company has a process to calculate cost of sales correctly. Yes. I've seen many financial statements where you would expect that there is a calculation of cost of sales, but you don't find it there. Okay, so when we're dealing with this chapter, we're gonna try to zoom in to say, in this type of a business, we're expecting to have cost of sales. Those are the business mainly that sell tangible goods. There's normally a process to calculate cost of sales there. The company has a process to deal with opening and closing stock inventory. We were once approached by a client, and in our list of services, we said we help with inventory management. And this client was so excited. He was involved in. He was an electric contractor. He approached us and said, "Hey, Mr. Uzana, thank you so much. Hey, I've been looking for someone who's gonna take care of my stores. I really need an accountant who's going to help us with that. My budget is 10,000 rand." And we said, "Wow, 10,000 rand a month, and we're going to take the job." Then we visited there. It was a big workhouse, and there was just everything. There were chairs, there were screws, there were cables, there were old screws, there was just no process of and we ended up not taking the engagement, because one of the problems that there was no requisition process. There was no time to requisite. Someone would be installing something maybe at 4K and decides that he's running short of a cable. Then that person runs to the factory and take the cable he needs. And for us, it's difficult now to say, okay, which cable did you take? How many meters was the cable? How many meters was on stock and all those things? So we ended up saying no. So it's a very complicated. I don't like even inventory, especially on situations like that one. Better if the inventory can be computerized, but if it's not computerized, then it's not computerized. and it's gonna give you hard time. You must just understand it. But if you are working, because it's all about education. If you are educating your employers on what must happen, or your employees on what must happen, and you've got enough system in place to cater for those instances, then there is no problem. And the only difference now is that what do we do on instances of emergency, but all of these require resources, and if resources are not defined, timing is not defined, processes are not defined, and all those things, then we're going to have problems with revenue, with inventory. But again, the sad part with this one is a yes or no situation. All right, so the company has a process of determining inventory write downs. Okay, sometimes write downs, you'll find them in a fast food supermarket, like the institutes, like entities that are selling food. There you'll find that the Rama is about to expire and they put it on sale. So when they put it on sale, it means that they understand that it's gonna be write down. It's not gonna be sold. It cannot be sold. So they that is a process of getting rid of it. So sometimes that processes of determining write down is a form of a policy. So you can say yes if you've got a policy of determining write downs, because it means that someone is gonna just move around the fridge and all those things and look for the expiry date and look for items that I'm sure also you would have seen in some of the clothing shops, that some of the items are gonna be put on sale 50% off. That is a write down policy, because that is a write down activity, because you will find that the jersey was sold for 150 rands, but now is 60 rands, because it's no longer winter. They are just clearing the stock, because they don't even have a warehouse to keep the jersey up until the next winter, and the jersey was in this winter. Chances are it will be out of fashion next year. So that is another write down pulse. But what is important here is to understand what form of entity you are, and do you have these tangible goods, and how those are going to affect your inventory. So SPPSA is very strict there in terms of inventory management. They only have 8 questions, with the 8 questions being that, is there a process of dealing with consignment stock? In other words, if I am selling sand, which is mine, but another contractor ask to keep his sand in my premises, what system do I use to separate the sand that is mine and the sand that is not mine? Because you'll find that that contractor is building a school next to where I'm selling, so they are delivering sand to my premises for safekeeping, but the sand is not mine. So I think, well, it can happen in any business where you find that you are also keeping employee things inside your premises, even things that are not even yours, because they find your premises to be safer than where they stay. And sometimes you use the employee things for your own purposes. But what this requirement, chapter 12, is saying, that we must keep adequate separation of documents between the two. Look on this one, on this example, the inventory was 75%, and it means it's not compliant. And after a meeting here, the chartered accountant and the small business owner are gonna sign there. Intellectual property, remember, when it's not compliant, it goes to part F. Even if when it's compliant but it's not 100%, it goes to part H. So it's part H, not part F. It also goes to part H. Okay, we've already dealt with why maybe there are only 4 questions on companies and property intellectually, on companies and intellectual property commission. Question 1: the company is in business with a CIPC and is compliant. Then you can just print that face page of the compliance status there. Then it's a yes. Then there's evidence. So the date, it's very important. You cannot publish financial statement on 30th June 2024, but your evidence that this business is in business with CIPC on the 1st of January the previous year, that is wrong. So at least it must be in that month. Okay, at least the company correctly calculates its annual return. Then this question talks to revenue. Revenue must help us to understand exactly how the revenue was determined. All right, so whether this is calculated accurately or not will depend on whether the entity is compliant, more than 80% compliant with the revenue chapter. The annual return declared exactly on the day of the anniversary. So it means that some of the dates that one should know is the anniversary date of the business. So when you register with CIPC today, so next year on the 8th of June, it's gonna be your anniversary with CIPC. So an anniversary with CIPC calculate for a period of a year. At the end of the year, you must file an annual return. All right. So you must understand. So that anniversary must be in your schedule of costs. Remember, the calendar of costs. Remember, we said you must keep a calendar to say this is what informs my calendar. Is the amount declared similar or will be similar to the amount declared on the financial statements? Yes, it should be similar, and the proof of that is based on the revenue schedule that has been calculated, because the revenue schedule must cross-reference to the management accounts and must cross-reference to the financial statement. So there's no way it can be no here. What are you trying to do? Then we go to chapter 14, cash and cash equivalents management. How many bank account? The company has one bank account. If you said yes, it means you're correct. If you said no, you are correct, but it means there are more. All right. It can really be a challenging exercise to deal with multiple bank accounts, but you will see how we deal with this when we are dealing with chapter 14. I'm so excited about volume 6 on how we're gonna deal it. Okay, let me not say it. I think this combined assurance template will come more handy when we are dealing with financial statements in our next video, and when now we're dealing with each chapter in volume 6. It's amazing. The company has got a policy and narrative to deal with intercompany transactions. So the intercompany, it's when you've got more than one bank account. You take, okay, this is the account from where your customers will deposit money. They put money there. But you also have another account, so you take money from here to here. So this is not a new sale from this account on this account. This is a transfer. All right. So the bank balance is still the same. But you'll also find that within this account there are other accounts. All right. So what will happen is that the customers will pay in this account 50,000 rand, and you take 20,000 rand from this account to this account. All right. So you are left with 30,000 rand. But when you add all the accounts, you've got 50,000 rand. Then this 30,000 rand is used, all of it. Then you used this 20,000 rand, you up this. So when this 20,000 rand comes up again, it's not a new sale, it's just a transfer, So those are the things that we're gonna be dealing with when we're dealing with cash management there. So that is the difference between intra account and inter account. So the 20,000 rand you deposited to this bank account, you could still deposit back to this account because you want to use it in this account, or the deduction is linked to this account. So it's not a new sale, So those are the things that we'll be dealing with there, and which are really confusing to most people there. The company uses a petty cash system. A petty cash system is when people come with cash and pay you with cash in the business. You take some of the amount to the bank, but you leave some of the amount within the business to buy stationery, cleaning material, envelopes, and all those things. Then at month end, when we're calculating how much we have, we need to understand what is your petty cash system policy. It's normally called an impressed system. All right. So you need to tell us more about that. So if you are saying yes, it means that when I print your bank statement, I said, give me your bank statement, and you give me your bank statement, and I read that with a yes. It means that even though your bank statement is showing 50,000 rand, now that you put yes here, it means that there is money that is in your premises that is not included in this bank statement. The company has a process to determine bank charges. Bank charges can really be a nightmare. Remember, one of the things that we said must stop immediately is you using a personal, you using a bank card for personal purposes, and it makes really the process of determining bank charges to be a nightmare. And if you are using a bank card precisely for business purposes, it's easy to accept that the bank charges that are there are for the business. But there is a schedule that we have to deal with bank charges, at least as a starting point, to make sure that almost equalizes to accuracy. The company reconciles its bank account to its cash book. Okay, we're going to deal with cash book as well, because remember now, we see that there is an amount that is paid to the business. We see that there is an amount that is paid at the bank, and we see that there are payments that we're making from the petty cash ourselves, and we have seen that there are payments that we're making from the bank account, and we've noticed that in some instances where we don't have money, we're asking our friends to make payments on behalf of the business for us, and then it means that there must be a cash book reconciliation to say how much exactly do we have in a form of cash, how much do we really received, and how much we have really paid for. The company issues a cash receipts for its amount received or services or for goods sold. This one is a tricky one, because SPPSA is saying issue a receipts for the services that you have offered or for the goods. I think we're going to clarify it to say, I think the way I understand them is to say a company must issue a receipt for every money that they receive, because a receipt is all about saying we acknowledge that we have received a certain amount. That's all. All right. It doesn't have to be linked to a particular invoice. Yes, it might be linked to a particular invoice, but it's not a rule that a cash receipt must be attached to, for it to be valid, must be attached to a particular invoice. So from where I'm set as the trainer in this program, I think whatever amount that we receive must be receipted. It takes into account related party transaction reconciliation. Okay, that one is fine to say, because sometimes they don't pay and sometimes they pay. I think what is important here in this part is that when we must keep an accurate balance of related party transactions, so that, like any other data, so that we can see how much impact they have in the business. All cash withdrawals are supported by a valid supporting document. So when you withdraw, I've seen many bank statements, withdraw, cash withdrawal, ATM withdrawal, but there is no supporting document to say why did we withdraw here. But the nice thing, SPPSA is very strict in saying all payments, suppose a withdrawal is a payment, must be explained to say what the withdrawal was for the better management of accounting documents there. The company has a policy of following up with unknown payments. These are set aside based on the period determined or predetermined income policy. Yeah, I think even ourselves, we've been in this situation for so long now, where you just get a payment, 20,000 rand, Hey, where is this 20,000 rand coming from? We cannot allocate it. And up until up to a year, nobody's coming to claim this 20,000 rand and so forth. And that is becoming a problem. So SPPSA is saying, because you need to determine your revenue accurately, and you need to determine your prepaid income, and you must determine your prepaid expenses, there must be a policy to deal with amounts that are deposited to your account which cannot be traced to a particular data. There is a cash and cash trends analysis within the company environment. Okay, this one is just analyzing the bank statement to say, in the month of January, this is how much we have received. This is how much. It means that we are just conscious and we are ready to take active steps moving forward. That's all what it means there. So other than that, and it helps us to keep informed about. I think it helps us to understand the season, because remember that cash trend is not happening on a month to month. It starts to happen on the month itself, to say which part of the month is taking more money from us. Then from there you compare it with the month to month to say, how much have we paid this month, how much have we not paid, and why. So that is just the trend analysis there of cash and cash, because it helps you to understand other pockets or other avenues in which you can get your resources sorted out there. Expenditure, we've already dealt with it, and we mentioned that the reason we're only having 16 questions there is that the expenditure is spread across all other chapters, and here we're consolidating, and for us to consolidate we don't need a lot of questions, and that's how we understood SPPSA trying to do. The company is a system and a process of determining, identifying, and quantifying its expenses of the business. That has been done, because if you have seen now, we have tried to understand every item in the financial statements from chapter 1 up to chapter 14. We've been dealing with that, and already we in pillar number 6, or these are 8 pillars, because this is 6, 7, 8. I think there was a mistake here. So we also have this cost determination here, all right, which helps us to understand the costs. So we have done that. That process is there. Okay, I am gonna be going through this this part, pillar number 7 on cost, and I'm gonna be giving you indications on what must happen in your business. So that one we've dealt with. The company have process of identifying its non-cash items. Okay, we're gonna explain when we're dealing with revenue what are non-cash items. But what is nice is that ever since we've started in chapter 1, we just have to deal to say this is cash, this is non-cash, this is cash, this is non-cash, and so forth. The company reconcile its expenses to its budget. We already talked about that, to say SPPSA is more emphatic on creating a budget. A budget is going to have line items, it's going to have a budget, and it's going to have a budget. It's what you think you will spend on a particular item over a year. Sorry, then it has got an actual, how much did you actually spend on that line item, and it's going to have a variance. A variance can go either way. It could be that you have spent more than you have budgeted, and you must explain why. Then once you spend more, you have more than what you have budgeted, it means that you unintentionally spend it. Then if you spend less than you budgeted, you must explain why you are doing that. So a budget is also cumulative. Cumulative in the sense it's comparative month to month, and is comparative year to year as well. So that process of reconciliation is there. The company reconciles its expenses to its supplier database. We dealt with this when we were dealing with chapter 1, to say that we must immediately create a database of suppliers. The entity separates between fixed and variable cost. We're going to do that per chapter as well. That is going to help us to say first why that is management accounting now. to say why it is important to classify our items as cash or non-cash item. That is number one. Then number two, why is it important to classify cash transactions or expenditure in terms of fixed or variable cost? And what are we going to do with fixed cost, and what are we going to do with variable cost, and what are we going to do with them combined? There is a process of separation between capital and revenue expenditure. We talked about this when we're dealing with finances, and we talked about this when we're dealing with revenue above, and we said we have a schedule that is going to help us to deal with that one, to make sure that our revenue is intact. The company has a plan to educate the employees about the cost. Okay, when we talked about employees, to say, is there a meeting where you sit down with employees and make them understand their impact to the business? That one we have solved also already, because it's also a requirement there on the expenditure chapter number 15. The company has a plan to process to identify suppliers with expired contract. This one we dealt with when we were dealing with chapter 1, because when we're dealing the supplier database, that is going to be taken into account there. Monthly and bank balance reconciliations and further investigation are instituted on time. The aim here is to follow the money and to make sure that the company is not using resources. I think one of the biggest problems here is that you find that the company is paying for a service that is no longer needing, or the supplier continues to deduct from our bank account even though we have terminated the contract. So that's what we're trying to stop there, because we don't want to lose money. Remember, we said SPPSA is an entity that wants to help businesses to continue in the foreseeable fact. So every cent, it is very important there. Okay, here this says the company has a policy of tracking and reporting completeness of business transactions. Okay, we're gonna deal with that one here. This part is gonna help us to understand all our transactions, and it's gonna help us to make sure that whatever that needed to be included on the financial statement has been included, and nothing that is there that does not belong there. Okay, the company regularly investigates new expenses, at least on a monthly basis. We also talked about this one, and we said we cannot, even if the expense is new, it must be budgeted for. And even though that process starts, we need to understand, why are we incurring these expenses now? Why do we think this expense is new and has not been there? And it helps us to stay conscious about the decisions that we are taking for the business. The company have a clear list of unpaid or accrual that is Schedule 2 of the expenses. We're going to deal with it here. The company records and keeps a regular transaction log. Okay, on a monthly basis, we do a transaction log. I'm going to show you how a transaction log ties up to other parts of the financial statement, and why a transaction log is important, and if there is any trend that we can pick up from the transaction log, and how that trend can be used for the continuity and to benefit the business going forward. The company follows the SPPAC form of identification process. Is it a 4 form? I don't think it's a 4 form. It's 1, 2, 3, 4, 5, 6, 7. It's a 7 form. It's not a 4 form. It's a 7 form. It's not a 4 form. Otherwise, I don't know why SPPSA, but it's a yes or no. But this template is an SPPSA template. So why would you single out the only one pillar and not the rest? I don't know. But SPPSA wants a yes or no. They know why. Because remember, SPPSA would have done an analysis of the users of financial statements, and the questions that they are asking here is what they think is important for the users of financial statements to understand. So we'll deal with that when that time comes. The entity have a process of providing management accounts for accurate recording. A management accounts is coming out of this document. It's just before the financial statements. But the users of financial statements might want to know if that process takes place or not. And it helps them to understand the financial statements much better. Because remember, it's not all the time where financial information is required at year end. There are instances where financial information is required beforehand. I'm going to make an example. SPPSA has got a financial year end that starts 1 March and ends on the 28th of February. So on the 28th of February, SPPSA is required to produce financial statements. But SPPSA may go to a bank in August and ask for a loan just before the financial statements are issued. So what the bank will say, they will say, give us your previous financial statements and the management accounts for this period. So what's going to happen there? Because you are issuing financial statements, you're going to issue this template with those financial statements. But because there's a process that you are also covering about on the management accounts. So you're gonna issue these documents together with part H of the financial statements. It is clear, it's clever, it's clear like that, SPPSA has been involved in doing that. So it's not a 4-component. Okay, the management accounts include all the 4 components. Yes, they must include all the 4 components. Luckily here, there are 2 questions and they are all 100%. All right. So there is a way in how we determine the management accounts at SPPSA, and we will share with you when we're dealing with management accounts. Financial statements. The financial statements are signed by the chartered accountant. Yes, we've been seeing here that it's the chartered accountant. The financial statements prepared in accordance with SPPSA recommendations. Yes, what are those recommendations? Are our volumes that we have issued? Yes, then it's 100%. Then you are okay, and it means that your business is doing very well. Okay, and now SPPSA has created this nice yardstick to measure all small businesses there. Environment. The company has an environment of a control plan. Yeah, because we've been dealing with control issues here. The company complies with the local municipality environmental bylaws. Then here you need to go to the municipality and say, my name is Holihla Dlavuzane. I am running this business. This business is running at this point. I want to be advised which bylaws I should comply with. Then you must sign a register when you get to that office and ask them to photocopy the register for you, because that is gonna be your proof that you went to the municipality. And the second proof that you need to prove is that you have gotten a schedule from the municipality that lists all the bylaws that are in the institution, and there was a tick and a signature next to the tick of the bylaws that are applicable to you. Number 3, you have taken those bylaws and you put them in your schedule, and you further analyze your applications according to each bylaws, and you are providing evidence of you complying with that bylaws, because SPPSA wants to produce responsible citizenry, and users of financial statements want to understand that, to say, what type of a company do we want to invest in? Is it the company that uploads the values of that upholds the values of the constitution? So users of the financial statements are very fussy with that one. The company contribute positively on the environmental sustainability. So it depends on what type of entity you are. For instance, we're accountants. We can say that because accountants is all about paper and ink. We consider environment before we print. We consider if it's necessary before we print. What do we do with the paper that we can no longer use? Have we shredded it? And there's an agreement with the company that is taking our unused papers to a place to dump them somewhere else, and all those things. So it's just a statement there. But you'll find someone else breaking glasses to make their products. That is, what do you do with the remaining glass? Where does it end up to? Other people are using different chemicals to produce what they want. So what do they do with the remaining chemical and so forth? So that part, I think that is CR 18. That's what also needs to be recorded on the financial statement. I think that one is also developmental, because you'll find that it had not registered on the psychology of the users. I mean, of the small business practitioner. Now that we're bringing it up, you'll find that now there's some form of conscious into now what is the expectation is. Then you write this is compliant 2 out of 2, it's 100%. Then you give here the number to say these are there were 20 questions. Status was compliant. Then the number that was green was 10. Okay, so it's just a summary of the sheet for someone to quickly make a decision. Ladies and gentlemen, it has been quite a mile, and I'm sure you are tired as I am. I'm sure you also learned how interesting this chapter is, and the value as PPSA has put in bringing this product, and how useful this product is to the users of financial statements. More importantly, the providers of capital, and the strategy around producing this document together with the financial statements has been amazing. We have never seen such a nice document in South Africa, and which must be read together with the financial statements, because what it does now, it gives meaning to the financial statements themselves. We're gonna deal with the value added statement. Then I'm gonna add the value added statement together with the cost register, then or the calendar. Then I'm gonna show you now the financial statements. And when we're dealing with financial statements, I'm gonna also, I think this combined reporting annexure will also be part of that, because we're gonna read the financial statements with it, which I suspect is gonna be another a mile of interaction between me and you, because then you need to understand how these two documents work together. My name is Kholhlatla Fuzane. Have a wonderful day. Thank you.